Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman. That's Brad Smith. Here are three things you need to know this morning. Heading to the House, the debt limit deal struck by President Biden and House Speaker Kevin McCarthy is poised for a vote today after clearing a critical procedural hurdle. Conservative critics of the plan were expected to put up a fight against the bipartisan bill, which freezes the U.S. borrowing limit until 2025. The so-called X date is fast approaching. Treasury Secretary Janet Yellen says the U.S. will not be able to pay its bills after June 5th. Treasuries have been rallying on the recent developments, with yields dropping from the 3.8% level that we saw last week. Traction on the debt ceiling means the data-dependent Fed takes center stage once again. And there is some key data to consider ahead of the June 14th meeting. Job openings today, non-farm payroll, CPI, they all come out before the FOMC's decision, and the markets are now firmly pricing in a hike. Cleveland's Loretta Mester doesn't disagree. Speaking with the Financial Times, she sees, quote, no compelling reason to pause interest rate increases. The Richmond Fed's Thomas Barkin also weighing in, saying that to take the sting out of inflation, he needs to see signs that demand is coming down. And a big month for stocks closes out with AI-focused companies very much in the driver's seat. The Nasdaq's rally was the story of May, with 5 straight weekly gains for that index. The ascent higher was driven by the likes of Nvidia, of course, which yesterday became the latest member of the $1 trillion club and the only one in the semiconductor industry. But can the push higher last? Citigroup strategists aren't so sure. They say positions are very much biased towards profit-taking, which they say could be a headwind for the rally.
Well, the debt ceiling deal moves to the House, so the Fed's June meeting is very much the focal point for investors now. Before the June 14th decision, we'll have a lot more information for the data-dependent Fed to chew over. On the docket are jobs openings today, as well as Friday's payroll number and the all-important CPI report the day before their decision. Cleveland's Loretta Mester tells the Financial Times she sees no reason to pause hikes. So what does our panel think? Joining for the discussion, we've got Yelena Shaletyeva, who is the BNP Paribas U.S. economist, and Paul Hickey, Bespoke Investment Group co-founder. Great to have you both here with us today. Yelena, I'll begin with you. What does this signal if you have Loretta Mester coming out and saying in full vocal force that, you know, there's still reason for us to look forward to some hikes, or at least ponder what that could mean if we do continue to input that into the economy?
Well, Ms. Mester is a known hawk, right? So, and she's not a voter this year. So, but definitely we need to pay attention to what everybody is saying on the committee, and hearing these voices against the pause in June is actually quite interesting. I think what we need to pay attention to is what the voters are saying, and we'll get 3 speakers today who are the voting members. So among them is Philip Jefferson, and we're also going to hear from Pat Harker as well. I think that will be very interesting to hear what they are saying about June meeting. Also remember that the key troika, right? Powell, Williams, and Jefferson himself, right, they are kind of like leaning towards a skip scenario, as they call it, right? So in June, I think they can afford to kind of wait and see what happens. There's a lot of discussion about long and variable legs, of course, and that needs to play out through the system. So we're still watching to see how this tightening in credit conditions is percolating through the economy. And I think that will be powerful enough to slow down the economy to such a degree that the Fed won't need to hike rates further. So this is our forecast, actually, that they will pause in June, and the data will deteriorate to such a degree that they won't need to hike further, and they will stay on pause.
Interesting. So a pause, maybe a skip depending on the data, but probably an actual pause, or maybe even an ending there. Paul, what about you? What do you think the Fed is going to do? And it's interesting the degree to which the market is now saying, yeah, there's going to be another hike.
Yeah, good morning, Julie. So it's really, we've had a major shift in pricing over the last few weeks. So I think a lot can change between now and the next meeting. But you see these comments from Loretta Mester saying no compelling reason to even pause. Well, you look at leading indicators crashing. You look at yield curves, 75% of the yield curve is inverted right now. There's a much more preponderance of weaker and weakening economic data than there is stronger and accelerating economic data. So, I mean, I have a hard time squaring those comments with the reality on the ground. And it's this point where 2 years ago, the Fed was so dogmatic in its belief that they didn't need to hike rates, and look what happens. So now you're seeing these officials coming out and being so dogmatic that we have to keep hiking rates, we have to keep hiking. And it just, there should be some balance in views, and to take one meeting off just to see what's going to transpire going forward is, I think is a prudent approach to take here.
And maybe a sign that they're not that dogmatic, perhaps. Right?
Well, yeah, so, I mean, I think that's what they should be doing. But then you see comments like this morning saying that there's no compelling reason to even pause. It just, it doesn't square. But as Elena said, it was, Mester's not a voter, and she's been known for hawkish commentary in the last several months. So, I mean, I would take it with a grain of salt. It seems every year there's certain Fed officials that are, just more bombastic in their approach and just looking almost for headlines rather than, to be taken real seriously.
And the Fed has to be data dependent. So let's talk about the data. The data are coming in, and there are signs here and there that things are actually slowing down. So you don't see it in the headline payrolls number, but there are declines in temporary workers, there are declines in overtime hours. And yesterday we saw the conference board data, which is telling us that jobs plentiful index is the lowest this cycle, actually. So, there are little things, and you have to look at the totality of the labor market data, and you see there's some slowing down going on. Having said that, the labor market remains tight, but I think that would be taken care of by the Fed staying on hold, at this high level of interest rates, and they will take care of inflation at some point. So the labor market data, right? So we have this payrolls report coming up on Friday, and we think we may see another upward surprise in the data. We're at 190, but over the last 13 months, the data have been surprising the consensus expectations, only to be revised down in the following months. So there's a lot of seasonality issues going on, and we can talk about that. But I think overall, the labor market data is slowing. We're just only in that first slowing phase right now, not in the rapidly slowing, falling down pace at this point. But that will come.
And we don't want to get there.
Sure.
Well,
No.
Yeah, I mean, going further along with that, and I'll let you continue on that thought, Paul, because something that you brought up a second ago was, we already know and have seen what the issues were in transitory for too long as a tone that the Fed was willing to continue to move forward with for an extended period of time. But what are the risks of tightening for too long without allowing for a pause?
Well, it's just as Elena was saying, just getting into that point where you get into the more rapidly declining employment and pushing things, over the edge. You look at inflation. There's complaints that inflation has been stickier than Fed officials would prefer. Services inflation has certainly been stickier. It's more plateaued than coming down. But you just look at the 5 regional Fed reports covering the manufacturing sector. Prices paid components on an average basis of those are lower now than their historical average. And so if you look at the pace that they came up and then the pace that they come down, it's nearly like an identical slope, just to the upside and to the downside. So, you don't get back to 2%. We didn't get to 9% inflation overnight. You don't get back to 2% inflation overnight. It takes time, but to just, keep pushing rates higher and higher just because it's not happening immediately, that runs the risk of slowing things down the road too much.
There's something else that's an important inflation input that I want to ask you both about. Elena, I'll start with you. Oil prices, which we really have been seeing come down sharply. We're looking at the 1 month chart. They're back below $70, back below $68 a barrel. Now, I know that the Fed doesn't look at fuel specifically, but obviously this feeds through and trickles down. Is this helpful to see this kind of rollover in this and other commodity prices?
Okay, well, the way it works and becomes important for the Fed is through inflation expectations. So if we see oil prices going into gasoline prices, which for the next CPI report we expect to decline quite sharply, and the reason is seasonal factors are expecting an increase during the spring driving season, but prices are actually going down. So that will show up as a drop in gasoline prices in the CPI report, which will help to weigh on the headline index. And when headline CPI declines, that affects inflation expectations. So we see that in the University of Michigan survey, for example, and there's like a special index there as well. So, that helps temper down inflation expectations, which is helpful for the Fed in the end. So I think, falling energy prices are helpful in that sense.
What about you, Paul? What are your thoughts on this tumble that we've seen in oil?
Yeah, so you look at gas prices, they're up 11% year to date. That sounds like a big increase maybe, but they're usually up at this point year to date, 18 to 19% year to date. So what you've seen is much smaller than average increase in gas prices so far this year. And seasonally, they tend to peak right in early June and fall throughout the remainder of the year. So that should be, as Elena was saying, a tailwind for inflation. And you look at crude oil, just in the last 2 months, you saw in early April, you saw OPEC come out and say, we're going to cut production in a surprise move. So crude oil, that rally lasted for about 3 to 4 days, and then prices stalled out right at the 200-day moving average and pulled back. You saw last week a Saudi minister, tell the market that oil speculators betting against oil better watch out. Well, that didn't really last long. Prices are right near a 52-week low today. So when you see those kind of, that jawboning have no impact on the market, it tells you that, it's a weak market. And this all comes in a backdrop when the China reopening was supposed to, boost oil prices. So we're at 52-week lows right now. I think in that respect, the oil market isn't telling you that the economy is really accelerating here.
Interesting. All right. Well, we're going to put that on hold. We're going to talk more about China a little bit later on. But Elena and Paul are going to stay with us because strategists are feeling bullish about the S&P 500, or at least more bullish, less bearish, thanks to a better than expected earnings season. RBC Capital Markets is raising its year-end price target for the index, with the head of U.S. equity strategy, Lori Calvasina, writing that more durable margins and investor negativity could actually generate more opportunity for equities in the year ahead. She's forecasting a 10% bump in the index. Now, earnings this quarter did decline 2.1% from the prior year, but that fall is much better than what analysts were expecting, the projected 6.8% drop at the beginning of the quarter. With the S&P 500 higher so far this year, is that upward trend going to hold steady, or signs of a bubble that may soon burst? We're going to get back to Yelena Shulyetyeva, who is BNP Paribas U.S. economist, and Paul Hickey, Bespoke Investment Group co-founder. Paul, I want to talk to you about breadth, my friend, because I know that is something that you have been watching closely. Yes, there is the earnings thesis, if you will, but there's also this idea that the big stocks have been dragging the rest of the market along. And in your latest note, you had some really great charts to illustrate this. One of them showing that the largest stocks are up a lot. The smallest stocks have not done well, and again, have been sort of dragging along. What does that mean for the future returns here?
Well, so you see, like, as you said, so the 50 largest stocks in the S&P 500 over the last 3 months are up 11%. 50 smallest are down 11%. So you just have seen this real dichotomy of returns. And immediately, whenever this comes up, people think back to 1999, 2000, when you saw a few tech stocks leading the market, and the rest of the market was, slagging along, not doing anything. So that's not the only time that kind of disparity has happened. And when you look at other periods, there's not a very large sample size, but when you look at periods where the S&P, say 100, which is the 100 largest stocks, outperformed the broader index by a wide margin, what you tended to see going forward more often than not was you tended to see the S&P 500 start to catch up to the largest stocks. So in that respect, you tend to see not necessarily the largest stocks then pulling everything down further. You tend to see a widening out of the breadth of the market, which tends to which would suggest some positive things going forward here. So in that respect, I wouldn't put too much credence on the 1999-2000 example, and I would just put more credence on some of these other examples that are highlighted in the chart you're showing right now.
And for Q1, even as we think about earnings being better than expected, in many cases, it was better than what was feared as well by many analysts who were tracking already lowered expectations coming into this earnings season too.
Well, that also applies to economic data. So we continue to be surprised by how strong the data are, right, and coming in. And, you just cannot see this rapid drop in economic statistics. So to the point of the breadth, though, I would like to add that the U.S. economy as well is experiencing the lack of diversification and growth. So like you see growth is concentrated into services spending. So we all want to go on vacations after we were stuck at homes for such a long time. So we're spending on services, we're spending on going out to restaurants, we're spending on vacations, Disney World, all these things. So,
speaking for yourself.
Yes. But in any case, when growth is so concentrated to one component, to one driver, this makes the economy vulnerable to exogenous shocks. So if something happens along the line, right, some issue with debt limit or any other external shock, that will put the economy in a very vulnerable position. And I think that could push us over the edge and into a recession. But for now, things are looking brighter than we were expecting.
Well, on a similar front, when we're talking about lack of a diversification, not only have things been concentrated in the equity market in big tech, it's really been all about AI, Paul. And even more narrowly, you could argue a lot of it's been about Nvidia, right? And you also, in your note, looked at the strength we've seen in chip stocks. You point out it's not just Nvidia. Many of the other chip stocks have also been doing really well. But the outperformance of the Philadelphia Semiconductor Index versus the S&P 500 has been notable. Is it a leading indicator as it usually is, or is there just too much focus and obsession there right now?
I mean, I think there is some obsession here. You saw that yesterday in the market. You saw the semi stocks. You saw a stock like Broadcom, open sharply higher and sell off. So a lot of these tech stocks sell off in the short term. So they've gotten ahead of themselves. The tech sector is more overbought based on the short term trading above its 50-day moving average than it's been at any time since 2004. That was as of the end of last week. So it's been a monster move in the sector. So you need some of that froth to cool off and at least pause and catch your breath. But this, the semis have been a leading indicator of the broader economy and the broader market for several years now, and they have been outperforming, and they are right near new highs in relative strength. And yes, Nvidia has been a lot of that, but as you brought up, Nvidia hasn't been the only stock, and most of the stocks in the Philadelphia Semiconductor Index are vastly outperforming the broader market. So that tells us that gives us positive signals for the overall market going forward. And it's just one of several factors that keeps us positive on the market, even when you see some weak economic data, in the form of leading indicators or weak manufacturing activity.
And Paul, I also just quickly wanted to ask you, I think of you as the guy who looks at these sort of historical comparisons and analogs in the market. And everybody's bringing up the .com era. I also think of when everybody was obsessed with blockchain or even metaverse more recently, and then they didn't really pan out as hoped. What's the best analog for the AI bubble, if it is a bubble, and what's going to happen?
That's a great question. I don't have necessarily an answer, but if you look at, say, Google Trends searches for for certain terms, you tend to AI has been just off the charts here. So again, I think it has a ways to be played out here, and there are some areas of froth, but I don't think we've seen nearly the level of froth in the broader market with AI than we did in the dot-com era in, say, March 2000. I don't think we're at those levels by any stretch yet.
All right, Paul Hickey, who is the Bespoke Investment Group co-founder, as well as Yelena Sholdatyeva, who is joining us and sticking around as well. Paul, thanks so much for joining us this morning. Let's take a look at shares of Hewlett-Packard Enterprise. That stock is falling in pre-market trading after the company reported its second quarter earnings. That came after the bell Tuesday. Revenue missed the street's expectations, the company reporting $6.97 billion in revenue. That's compared to the estimates of $7.29 billion. HPE also reduced its annual sales guidance for the rest of the year as a result of consumers spending less on servers, computers, and printing products. We'll dive deeper into the company's latest financial results with HPE CFO Tarek Robbiati today at 9:45 a.m. Eastern Time. You don't want to miss that.
In the meantime, a slew of economic data is on tap this week. We've got job openings coming up at 10 a.m. today. We've got non-farm payrolls coming Friday as investors closely watch for clues ahead of the Federal Reserve's upcoming meeting in June. So what will this data tell us or not about the state of the economy? Let's bring back in Yelena Sholdatyeva, BNP Paribas U.S. economist. And you sort of alluded to this a little bit earlier on, that the jobs data, it always gets revised. We had fraud issues with the jobless claims data. What do we trust when it comes to trying to figure out how this economy is going?
You have to look at the totality of labor market data, to use the Fed language. So I think the totality of data are telling us that we are slowing down. It's not rapid, it's not dramatic yet, but things are definitely slowing down. So if you look at the 3 months moving average of payrolls, it's been slowing down since like 2021. And we are at a pace which is still solid, but it's way below the pace that is consistent with really robust economic growth. And we'll see further declines, I think, in the pace. So I gave you an example, right? Temporary workers. Companies are not hiring. Companies are laying off temporary workers because they want to keep the permanent staff as long as they can. So they can lay off temporary workers, and that's a signal what is coming up in a broader for a broader labor force, because corporate profits are declining. And if you look at hiring intentions among small businesses, they're also trending down. Small companies also face an issue of tightening lending standards because they depend on smaller regional banks for credit needs. So I think we just haven't seen the extent of a slowdown that is about to happen. But we are starting to see these things happening. You mentioned JOLTS data. But something else is coming out today at 2 o'clock. It's the Fed's Beige Book. This is anecdotal evidence of what is happening in the economy. And in the previous Beige Book, we saw a lot of signs of credit tightening percolating through the economy. I think we will see even a broader tightening in credit conditions in this upcoming Beige Book. And that will affect companies' hiring decisions to a larger extent going into the second half of the year. I think we're going to see some declines in hiring rates in the JOLTS data coming up, just simply because while companies are not laying off workers still, they're hiring much less. And that is what we saw in the data in the Conference Board's survey yesterday. Jobs are becoming less plentiful.
Right.
But probably not yet hard enough to get.
Yeah, and consumers also very cognizant of that, even within that Conference Board data, talking about them being more downbeat about the opportunities for employment in the future compared to and relative to when they were seeing wages continue to rise to try and keep pace with a very competitive landscape for finding and acquiring talent. within the employment situation, though, the Fed has been able to lean on that within their own policy and pathway there. So if we were to see a recession to the extent that you were describing earlier, what would that look like even on the unemployment rate side that has remained resilient and near some of the lows, some of the all-time lows that we've seen?
So I think what we will see eventually is declines in payrolls, probably in the vicinity of 200,000 a month. That is typical. And we could see the unemployment rate rising to 5.5% as a result. But these changes will come later. So first, you see a slowdown in activity. And I think we're starting to see that in certain sectors like manufacturing, Paul mentioned, and like other sectors. Eventually the service sector activity will converge to a weaker manufacturing activity in our view, just as the economy continues to slow down as a result of Fed policy actions, and actually what happened back in the first quarter with the banking sector. That will play quite a large role in our view as well. So, I think we will see some increases in the unemployment rate down the road, but we may not see the full extent of it until the end of next year.
Something that's been interesting to ponder, especially with the turnover in certain roles that are being replaced by companies announcing that they're going to pull in AI to replace some of the call center jobs or some of the productivity tasks that steal workers' time away from other decision-making tasks that could be done. How far away are we from thinking of artificial intelligence as an employment situation input that needs to be considered more broadly?
We're a service economy, and even if you see at the airports that the computers replace people who like the waiters and others, we're still far away from a complete replacement. I think we're still a service economy, and we still need a lot of these service jobs. So I'm skeptical on that front. And productivity growth is great for the economy in the long run. So that creates better paid jobs down the road. So I think we're okay on that front.
Good. I'm glad to hear that.
All right, Yelena, you're going to hang around with us for just a bit more, because coming up, China's economy is showing signs of a slowdown. What that could mean for the U.S., we'll discuss and get you the opening bell as well. We're coming up on the opening bell on Wall Street, and we have been looking for some pressure here at the open. Take a look at futures there. All three major averages indicating a down day to end the month of May here, although we have seen strength over the course of the month, particularly in the Nasdaq, as we've been discussing, fueled by the enthusiasm, maybe to put it politely, over AI and everything AI related here. Also, the idea that earnings were not as bad as estimated. Oh, look at that. It's Women's Golf Day, apparently, there at the New York Stock Exchange, as we see the opening bell being rung. Let's do another check on the markets now that we've actually had the cash open, sponsored by Flex Shares. And indeed, we've got that lower open than we were expecting. The Nasdaq hasn't opened up quite yet here. And we got a little glitchity glue here as we get underway this morning, Brad Smith. But I suspect that the Nasdaq will be opening in the red when it does open up. I have no content to add on golf. I know you're the golf stan in the family, so to speak.
As I once heard someone say this morning, every day is a day, and for Women's Golf Day, it's a good day, especially for Titleist and FootJoy at the New York Stock Exchange. And so, as we're taking a look at the major averages here, we had a little glitchity glitch, as you mentioned there a moment ago, Julie. Though I fixed it as we're taking a look at the past 2-day move. All right, the glitchity glitch continues. Thought I fixed it, but anyway, let's try and load up another screen here. There we go. That Nasdaq Composite, that is cooperating here. Past 2 days flat, just barely to the downside. Here today, down by about 0.3%. We'll see if we can get the Dow Jones Industrial Average. Yes, we can. It's down by about 0.4% though, and the S&P 500, you're seeing that down out of the gate by about 0.4%. Past 2 days, net lower by about the same on a percentage basis. Let's take a look at some of the sector performance here. We'll pull up a heat map as soon as things calibrate behind me, but taking a look at some of the bigger movers that we'd seen, and as we were discussing over the course of this week, as we round out this month of May, really interesting to track to see exactly where some of the major averages net out after today here. Of course, for the S&P 500 and the Nasdaq, we'll see if they can maintain those winning streaks that we've seen over a couple consecutive months now. However, the Dow, that potentially going to snap its consecutive win streak. And so ultimately here, things still moving behind me, but hey, now we've got some action. Now things are responsive, and we'll get back to the sectors a little bit later on.
Well, in the meantime, it's not only Women's Golf Day, it's National Flip-Flop Day, apparently.
Ooh, love that.
National Macaroon Day.
Don't love those.
National Autonomous Vehicle Day.
They're all right.
National Fisher Folks Day.
I love fishing, actually.
There you go.
Never been fly fishing. Good freshwater fishing, though.
Important information for everyone to have. All right, let's switching gears for a moment. JP Morgan Chase CEO Jamie Dimon's in China this week. He said in an interview on Bloomberg that the bank will continue to operate in the country in good times and bad. It seems like the global power could be falling on some hard times. Economic data showing signs of a shaky recovery. Just for a quick comment on this, and then we're going to turn back to some other issues. Let's bring back in Yelena Shulyetyeva, BNP Paribas U.S. economist. So just quickly, I'm curious, even though there's a lot of talk about decoupling, right? We obviously still have a big relationship with China. Do we need to worry in terms of U.S. economic growth that the economy there is slowing? Will we see fewer Chinese tourists in the U.S., for example?
It's just one other piece of a puzzle. I think the U.S. economy is slowing regardless. We are having depletion in excess savings, and the U.S. consumer is going to slow down in spending and so on. I think the way the global economy affects us is through the markets to the main degree. This is how it percolates into the U.S. economic story. We're still quite a big of a domestic economy, and what drives economic growth is consumer spending. But definitely that could also just deliver that additional nudge and push us further into the recession story.
And so even as we think about a few of the elements within the employment situation that have larger economic impacts, payrolls is something that you're also tracking as well. Why is that?
So this is key data. This is key economic data ahead of the June FOMC meeting. And I think it will, all dimensions of this report, whether it's payrolls growth, unemployment rate, average hourly earnings, will have a say in what they will do at the June meeting. I think it's a live discussion. It's still a live decision. It's not been decided what they are going to do. If it's a strong report, I think it will send quite a strong hint that they will have to go But as of now, I think we will see our projection is for some slowing in economic growth, in payrolls growth, a little bit of an uptick in the unemployment rate in the upcoming report.
You know, we in the media like magic numbers. What is strong? What's the number over, like, that they can't ignore, they're going to have to raise?
I will give you a strong number,
okay.
right? So 250 will put the 3 months average on an unchanged kind of a pace relative to the recent history. So I think anything above that would be considered very strong.
Anything above 250, a rate hike is more likely. Elena, thanks.
Nice. Yelena Shaletyev, who is the BNP Paribas U.S. economist. Thank you so much for
Great to
taking
see
some time.
you. Thanks
Really
for coming
appreciate
in.
for inviting me.
Absolutely.
Come back soon.
Great conversation. Everyone, switching gears here. American Airlines showing some strength today. The company raising its expectations for adjusted earnings per share for the quarter to $1.45 to $1.65. That's the range. That is up from the previous range of $1.20 to $1.40. They're saying that this is going to be the busiest summer for air travel since, checks watch, pre-pandemic. American stock popping on this news. It's up by about 1.7% here as we're keeping a close tab on shares of AAL. Also perhaps worth keeping tabs on some of the other airlines that could be moving in concert, thinking about DAL as well on the day, as they've already signaled where that strong demand is. We've heard that from Ed Bastian, who talked about this in their most recent earnings as well. And a lot of the kind of theme that you're sensing from many of the travel names, whether it's our conversations with Delta CEO Ed Bastian, or whether it's with United Airlines CEO and even Airbnb CEO Brian Chesky, it's that the travel and services within the experience economy are still continuing to do strong as consumers are prioritizing that purchase here, as much of that pent-up demand continues to permeate even into years after when it was set to come back in full force, as people were just looking to get out of the house. We're now multiple years removed from that, and people are still spending on those experiences.
Yes, they are. Let's put some numbers around this, right? If you look at the TSA numbers over the Memorial Day weekend, the 4 days of Memorial Day weekend, 9.8 million passengers almost through those airport screening checkpoints. That is 300,000 higher, not only than last year, not only than the year before that, not only than during the pandemic, than 2019, 300,000 more than 2019. So obviously you're seeing this uptick since then. So there's the demand. That's just to put a little color around that. Then you have the fuel part of this, which is important for American Airlines. The company now says in the second quarter, in its fiscal second quarter, it's going to pay in a range 10 cents less per gallon for its average fuel. So fuel prices are going down, demand is robust. That's a good equation for them.
Yeah, it's a trend that's locked in right now. Q1, you actually saw that was the first quarter, first full quarter since pre-pandemic that we had actually beat those pre-pandemic numbers for the entirety, and it actually came in at 102% of a pre-pandemic marker there. And so that considerable in the first quarter, and seeing that over the entirety of that 3-month stretch. And so it seems with that trend locked in, American Airlines, United Airlines, even Delta as well, a lot of the airlines right now signaling that this is something that they can continue to ride the tailwinds of, if you will. I know I was in those numbers as well over the weekend.
Let's talk about HP. Those shares are slipping today. The computing giant did report better than expected revenue, but weak PC demand weighing on numbers. It saw personal system sales down 29% for the quarter. The shares are off by about 4.5% here. Overall revenue down 22% as well. The company did leave its free cash flow guidance for the full year unchanged, which you might think would be a little bit more reassuring. It also narrowed its full year profit forecast, which was above estimates. And what's also interesting here is Enrique Lore, who is the CEO, did make some comments seeming to indicate the second half of the year was going to be better, maybe pointed to a bottom for the PC market, which is a little bit more optimistic. But that is not showing up in the action this morning.
Yeah, no, that it would be welcome news. However, the reality of it actually being the bottom of the PC market, which hopefully that means that there is a super cycle or some type of cycle reversal around the corner that does benefit the company. But as of right now, we have not seen that so far. Also, we got to talk about Advanced Auto Parts. Shares plummeting today. It was down more than 20% 24% in pre-market. As of right now, you're seeing it down 30% as trading has commenced here. The company missing analysts' expectations on the top and bottom line, but it's really earnings that investors are disappointed with here, as well as the guidance. Earnings per share for Q1, that came in at 72 cents, with analysts expecting $2.60 a share. The company also lowered its full-year earnings guidance, now expecting $6 to $6.50, revised down from $10.20 to $11.20, that being the previous range. So this not a good day trading-wise for Advanced Auto Parts, ticker symbol AAP, as we were showing there on the day, and there you're seeing that decline here that ensued after this report dropped.
Yeah, and just a couple of quick comments that I'm seeing from analysts here. The analyst over at Truist, Scott Ciccarelli, saying whatever could go wrong did go wrong here. And he talks about they reversed their prior pricing strategy, and that caused a prior downgrade from Truist. But he says, quote, the unravel has been far faster and more violent than we had anticipated. And that echoes comments from the company itself. The CEO saying that things were worse than they expected and that it is a competitive environment right now, which again shows that, I mean, what that seems to indicate is on the inflation front, you are seeing areas where pricing has come down. Yeah. It's just not in what people are spending money on right now.
Right. Yeah. Well, you never want to hear an acknowledgement of Murphy's Law within any type of earnings coverage. Coming up, Hewlett-Packard Enterprise is jumping aboard the artificial intelligence train. We're going to speak with the company's CFO next.
Shares of HPE are in the red today after the company took a hit from a slowdown in spending on cloud services, bringing second quarter revenue in below expectations. But despite a weaker than expected revenue forecast, the company does see potential with artificial intelligence. Tarek Robbiati is Hewlett-Packard Enterprise CFO. He's joining us now, along with our executive editor, Brian Sozzi. Tarek, it's good to see you. Thanks so much for joining us. We're all trying to figure out the size and possibilities around AI, right? Can you tell me right now for HPE, how much of the business is that, and whether it's just that spending on everything else continues to sort of be weak and slowing, and that's responsible for this past quarter?
Yes, good morning, and thank you very much for having me on your program, Julie. So the AI opportunity for HPE is very, very significant. And it comes from the fact that we have unique manufacturing and engineering capabilities to assemble the large systems that are needed to test AI models. And by way of an example, as you may remember, in the first quarter, we delivered the largest supercomputer on the planet, which was Frontier, which is a system that powers simultaneously 37,000 GPUs that work as one machine to test complex models for the Department of Energy over here in the United States. And so on the back of that, we are winning substantial orders from our customers. So far, in the past few months, we've earned $800 million worth of orders and counting, and this number is set to grow more and more. Why is that? It's because to test those AI models of the future, you need a very substantial computational power, which we're capable of building. And then in answer to the second part of your portfolio, the portion of the portfolio that is currently experiencing a slowdown is a traditional compute servers business that we have. It is representing less than 40% of the total revenue of the company. The rest, our AI business, our intelligence edge business, are performing extremely well, and our Aruba networking business has grown 50% year over year and 15% sequentially, which shows there is still a lot of demand at the edge, which we intend to capitalize on. And so when you look under the hood at our results and our earnings, you see a tale of two stories. The traditional server business that is slowing down, and it's cyclical by nature, but you're seeing a lot of growth in AI and at the intelligent edge.
Tarek, Brian here. Good to see you as always. $800 million of AI-related business, that's a huge number, and I think that surprised a lot of people out there. When you talk to investors, do you think they're underestimating HPE's opportunity in terms of sales and profits as it pertains to AI? Because I hear a number like that from HPE. I think what Nvidia said last week, I mean, that guidance from them was about a couple billion higher than consensus expectations, telling me the street is just way off in how they model companies like this.
That is true, and I think, there is a lot of hype around AI, and there are lots of companies that claim to be AI-like. Then the question is, who are the companies that are capable of building those systems? And we feel we are one of them. We believe that we have the track record as demonstrated by Frontier to really deliver very large AI systems that are needed for the future. Because the reality is when you're testing an AI model, your AI model is as good as the amount of data it has been tested with. And to test that amount of data, you really need a very large machine. And small AI systems are not going to be able to deliver on the promise of the future, which is very accurate models that are predictive of what's happening in a particular industry. So you have to look at this under a critical lens because there's a lot of hype in that space, and be discerning, please, around the opportunities and the companies who can pursue this new wave of growth.
Right, and so because of that, yeah, we've probably heard a lot of talk, but kind of sparse on details over the course of this earnings season, especially with all of the AI mentions that we've gotten. You gave us a figure in that $800 million worth of orders, but if you think further out, are you able to quantify the benefit to the revenue run rate that you would expect to achieve because of the AI investments that you're making right now?
The 800 number is just a start, and we see the opportunity being much larger as there are different business models emerging for us. Whereby we either build those machines for cloud providers, and some of the $800 million that were realized in terms of orders were around customers in the cloud space. There is also different types of business models where we are going to build machines ourselves for us to on lease with our GreenLake platform. there's many, many opportunities that we can capitalize for the future at HPE around AI with the technology and know-how that we have.
Tarek, we're talking about this $800 million in orders. I mean, I'm looking at your revenue for last fiscal year, which was something like $28 billion, right? So this, I get the future proposition here. This is not the bulk of your business today. And that seems to be, again, what the market is reacting to. When is that business going to see more of a recovery? How long is this dip in this spending cycle going to last?
It's very true. We are about a $30 billion company. And within that, you have about 12 billion that is about general compute servers. This business is very cyclical, and I want to remind you and your audience that in the past 2 years, we've witnessed unprecedented demands where companies were buying servers in a context where supply was scarce. And so it is normal that this portion of the business is actually experiencing a period of digestion where customers are digesting the past investments that they have made and eventually will resume on the buying pattern. That is only a portion of our business. The rest of our business, AI and also our Edge Aruba business, are doing extremely well. Our Aruba business grew more than 50% year over year and 15% sequentially and delivered outstanding margins. And when you really analyze what's performing under the hood in our company, is this margin story that is coming out of this mix shift of the portfolio away from general purpose compute onto AI and networking. And this is why we were able to up our operating profit guidance for the full year and our EPS guidance for the full year as well. We're also pretty much generating a lot of cash out of these businesses, so we are very well equipped to use that cash to invest it for future growth as well.
Tarek, what is driving that cautiousness right now amongst some consumers of HPEs, and do you see that starting to turn in the back half of this year?
So what has happened in the second quarter, as you recall, is there was a major slowdown in the banking industry. We have a number of banking clients globally. And when you really look at our compute business, overall in the mid-market, we're doing fine globally, whether it's Asia or Europe or even the United States. Where there has been a slowdown, and it was very much witnessed in the manufacturing and financial services sectors, which have taken a pause on their spend following a large amount of purchase during the course of calendar year 22. And we do expect spending to resume. It's really difficult to call a bottom, particularly for our service business in the circumstance, but we do expect spending to resume once this digestion phase is over. It's a matter of maybe a couple of quarters, and from there on, it should be a different story.
And how does that trickle through to margins in the near term right now?
It's a great question. So this cyclical business of compute is relatively low margin. We are right now posting 15% operating profit margins. And the story overall for the company is one where we have Aruba, our business in networking, which is generating 26% or north of 26% operating margin. So it's a mixed story. And as one business slows down, the other one picks up. And the margin story is intact and actually is very strong at HPE Enterprise, which has led me to raise operating profit guidance for the full year and also EPS guidance for the full year 23.
Tarek Robbiati, who is the HPE CFO, alongside Yahoo Finance Executive Editor Brian Sozzi. Tarek, thanks so much for taking the time and breaking down some of the numbers here with us today. We appreciate it.
Thank you very much, Brad and Brian. Nice to see you again.
Good to see you. Let's get to Yahoo Finance's Jared Blickery on the floor of the New York Stock Exchange. Jared, what's good?
Well, that's a loaded question. I'll tell you what, we're seeing a little bit of green, but guess what? A lot of that is just centered in tech, and that really has been the story. And I just want to direct everybody's attention to the Wi-Fi Interactive. Here we got the Dow, but I'm taking a look at the bond market. Now, the 10-year T-note yield, which had been accelerating in May, is getting a little bit of a reprieve, and we'll see if I can pull this up here, over the last 2 days. And so this actually favors the growth trade, which already seemingly had been in favor of the growth trade, and that would be long duration in those tech stocks. Now, whatever happens with the debt ceiling, and let's say this is resolved in the best possible manner, we're still going to have the Treasury refilling its coffers over the coming months, and that assumes everything runs perfectly in between. And then we have a tightening in terms of basically QT in Europe as well. So we don't even have a handle on the exact figures, but it's something like $500 billion to $1 trillion we're going to lose in liquidity this year. So another thing I'm really watching like a hawk is the ISB of a move index. You can see that's on the Wi-Fi Interactive right here. Over the last 2 days, you can see these two green candles here really picking up here. And when we have bond market volatility, guess what? That usually spills into equity volatility, currency volatility. Everything is related. So definitely get some cross-pollination of risk. And if it starts in the bond market, eventually it's going to hit equities as well. Now, I also want to say one more thing. This is about seasonality that we have in the month of June. June, as it turns out, not the hasn't been the greatest trade on average over the last 20 years. And here is a chart. This is the seasonality, what the market typically does. And the first thing you'll notice, yes, it is from the lower left to the upper right for the most part, but that red box right there, that is June. And guess what? Usually there is a bit of a loss in June. And for that matter, there's May as well, which you don't really expect too much from. And it gets back to that old adage that I really don't like to say, but it's out there. So sell in May and go away. Guess what? It's really more like hedge in May and go away. Lots of large institutions prefer to be on autopilot over the summer. They don't want to be in here. They don't want to be down in the nitty-gritty. Now, that would change if there's some huge paradigm shift in information. And we've seen this in years past where institutions are forced to come in over the weekend and kind of hammer out some business. But that is not the norm. For the most part, nobody wants to reposition. And for that matter, given all the low liquidity that I was just talking about, there's not a lot of high liquidity days in the market that they could actually do that without causing a commotion. One is going to be the Russell rebalance. That's coming up in a couple weeks. After that, really got nothing until the fall. So it's kind of where we are right now, in limbo.
In limbo. Don't we love that? Thanks so much, Jared. Appreciate it. Coming up, job openings hit the lowest level in 2 years in March. What are we going to see in April? We've got jolts coming up. We got the JOLTS data coming on through as we have been talking about, and it's coming out hot, folks. 10.1 million job openings in the month of April. 9.4 million is what economists had been estimating, and it's an uptick from the prior month, about 9.59 million. Actually, there's even an upward revision the prior month to 9.74, so call it 7.5 million jobs. So the job market is still hot if you're looking at this particular number. Now, I'll have to go into the release to see what kind of color we get from it. And I know you already got it open there, Brad. But overall, just to say again, 10.1 million is the headline number here, which is considerably higher than expected.
Yeah, in April, job openings increased in retail trade the most by 209,000. Healthcare and social assistance also doing their part. 185,000 jobs added there. Plus, transportation, warehousing, and utilities also rounding out some of the largest gains by sector, at least at 154,000 there. The number of hires, interesting, that was a little change, 6.1 million there, and the rate held at about 3.9%. Hires actually decreased in information by about 37,000 jobs there. And then just lastly here as well, total number of separations, that decreased to 5.7 million. So that was down by about 286,000 during the month of April.
Yeah, so interesting here. The number of quits increasing in wholesale trade. You talked about that. Maybe that's one of the areas of strength here. Quit rate decreasing in state and local government, excluding education. And we know there has been some more weakness in government hiring. So does this presage what we'll see on Friday in the jobs report? No, because it's not, not necessarily, right? Because these numbers aren't an exact.
Sure.
But, what we heard from Yelena Shulyatyeva just a little while ago from BNP Paribas, 250,000 if the job additions last month are above that number, that is going to put more pressure on the Fed to act. These numbers maybe do point a little bit more in that direction.
And that kind of mirrors what Citi had said as well. They were looking for upwards of 200,000 to really initiate that, have no choice but to continue in their policy pathway at the Fed if we did see more than 200,000 jobs come in, that as we were discussing just yesterday. And so we'll see exactly where that employment data comes through in the employment situation at the end of this week.
Yeah, I just want to take a look at stocks if we could here, because I want to see if we've seen any kind of reaction. It looks like that we did see things take a bit of a leg down. Do we have any intraday charts, folks, so we can look at that movement on, or even a 2-day chart for the major averages? Because it looks like we did see a little bit of a leg lower as we got these numbers coming out. Again, because does this then maybe solidify the idea that the Fed would indeed be raising rates? Yeah,
it seems like some of the move lower really initiated around 9:45 a.m., so a little before this data came out, but continuing to see exactly where, at least in the Dow and some of the other U.S. major averages, where there could be even more reaction to this figure, as it now gives even more inclination to how the Fed is still, of course, looking at and digesting some of the, yes, albeit lagging data, but some of the best economic data that they can continue to look at over their policy pathway. Coming up, everyone, as Nvidia briefly joins the $1 trillion club, we'll speak with one investment manager who's advising caution. That's next.
Welcome back to Yahoo Finance Live. I'm Julie Hyman, and that's Brad Smith. This is the Dow Jones Industrial Average. We're looking at the two-day chart here to show the move downward that we got after that JOLTS data a few moments ago. Job openings rising to 10.1 million last month from around 9.7 million. That was an upwardly revised number for the month before. So what does that mean? People are still hiring here and they're still looking for workers. And so what does that mean by extension for the Fed? Well, they might indeed have to raise interest rates at their upcoming meeting on June 14th, but we still have payrolls data. We still got the CPI before then. Regardless, what we saw was a leg down in stocks. You look there at the Dow, here's the Nasdaq, not down as much, or the S&P, excuse me, the Nasdaq as well, which is only down about 0.2% today. But let's kick it on over and take a look at some of the other indicators that we are watching. We were on a 1 month. Let's go to a 1 day here for what we're seeing. Nvidia pulling back from that very high level that we saw yesterday. So it's below $1 trillion market cap once again, but that is just for now. We'll see if it goes back up again to that level. And then we're seeing more of a mixed picture when it comes to the other large cap tech stocks. Quickly taking a look at the sectors here. They are all in the red. Energy leading the way downward. A big tumble in oil prices is what we've been seeing, not just today, but for several days. Last time we checked, below $68 a barrel. But I know we got to talk more about Nvidia, Brad.
That's right. It's been a big year for Nvidia as we've continued to track that stock. Over 170% in gains is what we've seen year to date. Plus, strong earnings made it the first chip company to briefly boost its market cap over the $1 trillion mark. But with the generative AI hype not showing any signs of slowing down, Nvidia may be the biggest winner of them all. Yahoo Finance's Dan Howley joins us now with the details. Dan, help us break this down even further. The company, Nvidia, they've been focused, $1 trillion club, entered, exited, but they're still in that ballpark.
Yeah, and let's just break down why NVIDIA is kind of in this position. The company had started, decades ago, and really their focus was on video games at the time. But as they started to try to expand, they were looking for new ways to grow their market, to take advantage of those graphics chips, and they opened it up to developers. And they basically found that, look, the kind of parallel processing that graphics processing units offer is infinitely better than central processing units, CPUs, at processing AI data. And so that's why we're seeing NVIDIA really take off here. The reason why they're beating the likes of AMD and others in this space as far as processing goes is because they recognized that early and they capitalized it by investing in it heavily. For years, they've been talking about how they're working on AI, how they have these servers, how they have the software. So they're a full stack company from soup to nuts, and they're the best to do it, and their products are in short supply. So people are really fighting over how to get their chips at this moment. We're not talking about small firms either. We're talking about the likes of Microsoft, Google, Meta. They're all trying to get their hands on NVIDIA's servers and chips. And so that's why this company really is taking off and why it's doing so well. Now, obviously, the generative AI hype has really played into that. But I think it's important to note that generative AI itself is very hyped, but it's not the end-all, be-all when it comes to AI. AI, as I said multiple times, has been around for quite some time. Companies have already been using it. That's why NVIDIA has been able to do so much work in AI. It wasn't just generative AI that made NVIDIA overnight a hit. They've been doing this for quite a while, working in the AI space, improving their capabilities, releasing newer and newer servers and processors, scooping up companies to make the interconnects between different pieces of equipment talk to each other faster. So this is something that NVIDIA has been working on for a long, long time. Generative AI, right now, it definitely is the most talked about type of AI. That, look, it might not be the final iteration that we see of AI. In fact, it won't. There will be new versions of AI that do different things. This is a specific portion of AI. AI is a broad range of technologies, and NVIDIA will continue to do well as far as overall AI goes. Now, there are going to be rivals. AMD is working on things. Intel obviously working on things. Qualcomm coming out and saying that they're all about AI. You have Broadcom and Marvell. They're all working on their own technologies, whether that's with third parties like Google producing their own chips or not. For now, though, NVIDIA really is riding this hype train, and they're the conductor.
I like that analogy, Dan. Thank you so much. Appreciate it. Well, despite NVIDIA briefly joining the $1 trillion club alongside tech giants like Apple and Amazon, our next guest is warning investors to be skeptical and cautious. George See is Annandale Capital founder and chairman. He's with us now. I mean, $1 trillion is a nice big round number, right? That catches a lot of people's attention, George. But what do people need to think about when they're looking at companies of that size and whether now is the time to get in?
Hi, Julie. Good morning. And you know, the old cliche, discretion is the better part of valor. Sometimes it pays to be discreet and cautious and careful. And we've had quite a rally in the Nasdaq in particular this year. It's been a very concentrated rally in high growth tech stocks after a big correction last year. And you have to be skeptical after a move of this magnitude, especially with all the headwinds against the economy and with the Fed still at war with interest rates and inflation. And I think it's a really good time to take a pause and reflect and make sure your portfolio is well positioned against what's going to come in the next 4 to 5 months. And I think we're overdue for a correction in the market, especially in growth stocks. So I'd be very cautious right now if I were an investor.
Artificial intelligence may have won this earnings season, but how can investors make sure that their portfolio, I guess, wins out over the long term as the actual beneficiaries of artificial intelligence and some of the capital that's been thrust towards it become a little bit more clear over time?
Hi, Brad. Well, that's a really good question. And I think that the winners long term are well identified by the market. NVIDIA is going to be a big winner. Buying it right now, though, after the move it's had, I think would be unwise, frankly. And I think you've got to look at some of the others like Google and Amazon and some of the other beneficiaries of this movement and basically spread your bets and have a good portfolio that's diversified across all the various companies that are going to benefit from this incredible capital investment move in AI and how it's going to affect all the various aspects of the economy. It was interesting to me to see Qualcomm come up and say, hey, we're a beneficiary of this too. Everybody wants to get in the game because it's basically a popularity contest right now. But as Warren Buffett and Benjamin Graham said many, many years ago, the market is over the long term is a weighing machine, and you've got to have substance to go along with the hype. And that's why it pays to be diversified across a whole lot of companies and not just one or two, because you want to bet on a wide variety of companies that are going to be playing in this field and not try to pick the one or two winners, because that's too risky.
Yeah, I mean, that's another example in terms of the popularity contest. We spoke earlier to the HPE CEO. That stock is going down, even though they also touted the potential for AI. So when you're looking at a basket, right, if you're trying to take advantage of it through being diversified, how do you even pick the basket, right? Do you just kind of buy all of tech or all of the Nasdaq 100, say, and just bet that enough of them are going to benefit from this trend?
Well, I think you need to weigh your bets accordingly. And I think that larger than a 20% allocation in this space would be too large. And I think that what you just said about the Nasdaq 100 would be a really good way to do it, or pick 5 to 10 of best of class companies that are going to be involved in this space, something like that. You don't want to be over concentrated. You want to be well diversified, but exposed, because this is going to be a big trend in the future. And investors need to have exposure to this. But I would say right now is not the right time to get started. If you're not already in it, I would be patient and wait for a correction, because you will get it this year for sure.
What are some of the areas where investors in the midst of all the AI hype perhaps are missing opportunities that are still right in front of our eyes?
Well, that's a great question from an investment standpoint. And that's the one we've been asking at my firm for quite a few months now in particular. And where we're really focused is energy and financials. They have been completely poured out this year in favor of tech and growth. And we think they're incredibly cheap and incredibly underloved. And investors want a case for shorting them or selling them. And we think that's going to change at some point. So we've been actually very gently, slowly, patiently adding in that space. And we haven't been selling in AI or tech, but we've been holding our firepower, so to speak, and just standing on our positions we already have. So we're looking at areas that are unloved and underappreciated and a lot less expensive right now.
Let's expand on energy a little bit for a moment, because that group in particular lately has really been beat up as we've seen the slide in oil prices. Energy stocks have followed suit. You say at some point people are going to come back around to it. What's going to cause them to come back around to it?
I think inflation's not dead. I think inflation is going to come back, and I think the prices of these commodities are too low for the companies to make a meaningful enough profit, especially in natural gas. And I think that you're going to have supply come off tremendously in the next 3 to 6 months. And I think the price of the commodity is going to go up and the stocks are going to go up with it. And I don't know where the turn is, but we're pretty close at this point. So I think you want to buy fear and sell greed. And I think there's a lot of fear and Sturm und Drang, so to speak, from a German standpoint in the energy space. And I want to buy that.
George, thanks for spending some time with us this morning. George C. is Annandale Capital founder and chairman. Appreciate it.
Great to be with you all. Thank you.
All right, let's take a look at a trending ticker we're watching today. Capri Holdings saw revenue top estimates despite falling 10% in the fourth quarter as easing COVID restrictions in China helped boost sales. The Michael Kors parent company also saw a pullback in inventory, which was down 3.6% compared to a 21% jump last quarter. Capri CEO says they recognize near-term uncertainties in the Americas, but they're encouraged by growth in Asia. But all of that said, those shares are down quite a lot in today's session. So they might be encouraged by the growth in Asia, but definitely we are seeing, the weakness reflected. It looks like the company cut its forecast for annual revenue growth, and that's not the first time that they have done so. So that appears to be what is weighing on those shares. And coming up, student loan payments are coming back. How to fit them back into your budget. Next. Let's do a quick check of the market, sponsored by Flex Shares right now. Stocks are remaining in the red. The Dow leading the way today, off by 0.75% with the S&P and the Nasdaq following suit here. Seems like the market's forgotten about the debt ceiling already and the resolution that seems to be, knock on wood, pending, and is now turning its attention to the Federal Reserve. Well, student loan payments are set to return in September as part of that debt ceiling deal. So how can loan holders readjust their finances for the extra cost? Joining us now is Catherine George, Wellstream Advisors financial advisor, and this segment is sponsored by FlexShares. Catherine, thanks for being here. I mean, people have a lot of different debts that they have to deal with when doing their financial planning. Student debt seems especially insidious, right? At least reputationally, certainly. So for people who had gotten used to not paying this stuff for a little while, what do they do now? How do they sort of make room for that?
Right. It is a big shock to the system. We have been on pause for 3 years, which is really crazy to think about. So it has not been top of mind for our everyday life. The most important thing is to come up with a plan ahead of time. So in anticipation that these payments are going to start back up, really take a look at your budget and see, where you're spending, where you might be able to cut back and how you can fit that in. And if you don't see any room, really do a deep dive on what repayment options are available to you, because there are some flexibilities in how you'll be able to pay that back as opposed to other types of debt that you have. There is a bit more flexibility. But the most important thing is to come up with a plan ahead of time and feel prepared and not panicked.
Are there any available kind of loan forgiveness programs or even cancellation programs that people might be eligible for?
So there are, and it's extremely nuanced. And you read articles that even people that have followed the rules and done all these things sometimes still have trouble, getting accepted into those programs. So you really have to do a lot of research and making sure that you're taking the necessary steps to do that correctly. But then, of course, we have Biden's proposal to forgive student loan debt for everybody, which we don't know where that's going to go. So before you're making any large, chunks of payments to those federal student debts, I'd wait to see how that all shakes out and if we'll be able to get mass forgiveness of student loan debt. But even those, the repayment options, if you don't have a high income or if you have a temporary layoff from a job, you should be able to get some exceptions and pause your payments for a period of time while you get back on your feet. So there's lots of options and lots of research to do there.
And it sounds like, Catherine, you're even saying that maybe you pay off the minimum required until it gets resolved by the, this proposal that the Biden administration is making for the longer term.
Exactly. And even if this doesn't get passed through, oftentimes student loan debt interest rates are much lower than the other debt that we hold elsewhere. The good news about student loan debt is that if you have it today and you graduated a few years back, those interest rates are at lower rates than we are today. So it'll be significantly lower interest than what you're paying on your credit cards, any other personal types of loans. If you just got a new mortgage, all of these rates are substantially higher than what our federal student loan payments might be. And we're able to earn money on cash now. So really comparing what I'm earning on my high yield savings account versus making that extra payment to the federal student loans, all of that's a big factor.
You mentioned a key word within there, and that is federal. The majority of these student loans are federally held. So what about for those who have private lenders? What recourse, what negotiation can they put forward?
So it's really tricky because every service provider can be very different in how they handle you not paying your payments or what options they might provide. So there's a little bit more research to do there, but generally the interest is much higher on the private side when we compare the federal side. However, there are companies that will consolidate debt and offer you lower rates than what you're paying today. But again, it takes some research, understanding how that impacts you and the monthly payments. There are some options, but it is trickier than the federal side.
I'm also curious when people are looking at their various debts, how they should be prioritizing them in terms of, in what order they're going to pay them off versus, of course, whatever they're allocating to investments, et cetera?
So, as I mentioned before, the federal student loans likely have much lower interest rates. So it's really not a bad debt to have for a couple of different reasons. The first debt to focus on is definitely credit card debt. The interest rate that you pay on that debt fluctuates with interest rates and the interest rate environment. And as we know, those rates are going up, and we don't know when that will stop. So the rates are extremely high to borrow from credit card companies, and that's the number one place to start. And then any other private types of loans that you might have is the second, and then federal student loan is likely that last tranche. But when we think about it compared to whether we pay off debt or build a cash reserve or we invest our money, it's really, you should get some advice from a professional. But generally speaking, I would pay off that credit card debt before you build a cash reserve, because you're paying a lot to borrow. And then, really do the minimum payment on that federal student loan. And if you have any extra, you can start to build a cash reserve. If you have a cash reserve, then you can start to invest in your portfolio. But really feeling secure before you put any money at risk in a stock and bond market.
Is there a general rule of thumb, Catherine, if you're still holding on to student loan debt, but at the same time you say, you know what, I've saved up for a house that I'm trying to get approved for, and perhaps that's a better place to try and at least get approved, put forward and go forward with the process there? Is there kind of a general rule of thumb, a first thing that people should keep in mind when they are trying to balance that decision making?
So buying a home right now is also tricky as we're talking about these interest rate rises. A 30-year mortgage can be 6-7% to borrow. And of course, prices are really high in many home markets. But with that being said, of course, buying a home is an investment and also a place just for you and your family to live. So in terms of paying off federal student debt or going through this process of buying a home, as I mentioned before, federal student debt is not bad debt per se. And generally the rates are lower. So I would not start with paying that off. I would, live your life and pursue a home, investments, building cash before you fully pay down that student debt, especially with this Biden, forgiveness program floating over our heads without any clear deadline.
All right, Catherine, I've been taking furious notes over here. Catherine George, Wealthstream Advisors, financial advisor. Thank you so much for joining us here on The Day. Appreciate it. Coming up, dystopian much? Industry leaders warning AI could risk human extinction. What's behind the push to regulate AI's runway success, and how can it be done? That's what we're going to discuss next. AI seems to be the talk of everywhere right now, and companies are eager to get in on the hype. More than 100 earnings calls this quarter mentioned the technology. Leaders in the field are cashing in big time. Shares of Nvidia, C3 AI, Palantir, they're all gaining more than 100% each so far over the course of this year. But the boom in interest and investment has industry veterans sounding alarms. More than 300 scientists and tech leaders issued a stark warning yesterday. AI poses risk of extinction, and addressing it should be a priority globally. Signatories included executives from OpenAI, Anthropic, Microsoft, and Google DeepMind. Ashley Gold, technology reporter at Axios, joins us now to dive deeper into the push for AI regulation. Ashley, great to speak with you here this morning. All right, so you've been continuing to cover this AI space as well as the reaction from a couple key executives and what they're pushing back on. What are they all in concert about right now?
Executives are in concert that there needs to be sort of this global scale of regulation for AI. They want to see regulations both on the US federal level and for sort of globally across the whole world, there to be some sort of agreement on at least basic principles, guardrails or a framework for what the rules should be for sort of these high risk AI systems, which is how you would think of generative AI, ChatGPT, what we've seen explode in the past 6 months.
I mean, it's really hard to wrap our heads around a warning from these leaders that says we need to prepare for this like we would prepare for the pandemic, at the same time that they're also developing these technologies. So
exactly.
It's all very conceptual. Is there anyone who actually has a plan for how to prepare?
Honestly, I agree with you that it's totally conceptual. It's very hard for the average person to sort of read a warning like that and think, okay, I have a good idea of what the risks are. I better be paying attention to this. It's too pie in the sky. I think these AI leaders would do better in sort of describing how the advances of generative AI and other types of sort of advanced AI would impact our everyday lives with problems we already see in society: inequality, misinformation, sort of the inequality we're seeing across the board with late stage capitalism. I think what would make more sense is if we just talked about how AI will sort of impact our current problems, our current online environment, instead of sort of alluding toward this future where AI is everywhere, because people really can't wrap their heads around that.
How much of this is positioning from these execs, knowing that for regulators in Washington who have already had to try and get past the learning curve in everything from the metaverse to social media for some of them and even into blockchain technology, so forth, that they're not necessarily going to understand the ins and outs of how to even wrap their minds around artificial intelligence, how that regulation should move forward, and how, where there could be productivity improvements, bless you, where we could still see some type of framework that companies and society could operate within.
Yeah, absolutely. I mean, these AI leaders, they see what happened when social media really exploded, and it came to be that we had no real rules of the road for social media, no federal privacy law, no laws around how companies can handle your information. And there's been a lot of backlash, and social media companies have gotten in a lot of trouble and done a lot of congressional hearings as a result. These AI leaders are saying, this is inevitable. We're going to get out ahead of any problems now. We're going to set the rules of the road so you can't get mad at us later and say that, we broke the rules or we're doing things that are illegal or are too much. We want to work with you now to figure out exactly how we can go forward with this. So you sort of accept that AI is happening and we could all go for it together, and sort of an opposite way of how we've dealt with social media, which is looking at it after the fact and saying, we should have had some rules in place. Here are some lessons we learned. They're very much trying to avoid that.
They're trying. I don't know how optimistic we are. I mean, the EU has already acted on this, right? There are some lawmakers out there who have proposed things. I think Michael Bennet, the Colorado senator, has some ideas here. Tell us about that and whether it's actually gaining any traction.
So Michael Bennet has proposed making an agency to regulate social media and specifically artificial intelligence. He thinks that the current agencies where this would, fall under their jurisdiction, the Federal Trade Commission and the Justice Department, that they don't have the resources or the very specific expertise needed to regulate AI. So it's a lofty idea. I think getting new agencies propped up is difficult, especially in this political environment. You've seen how Republicans talk about the CFPB and other agencies like that were sort of propped up in the past, 20 years or so. A new agency costs money. A new agency is further government intervention in private markets. So as much as Republicans and Democrats agree on the need to regulate AI, and they really do agree, there's going to be, some disagreement over how much money can be spent to really, do research and invest here, and just how much the government should be involved. So I think it'll be very difficult.
Yeah, well, we'll see. Cross fingers, I guess. Ashley Gold, technology reporter at Axios. Thanks a lot. Appreciate it.
Thank you.
Coming up, a big month for stocks comes to a close, but it's not all about the rocketing Nasdaq. It was a different story for the more domestically focused Dow. We've got the breakdown next. It is the final trading day of May, and the tech-heavy Nasdaq saw gains of about 7% this month. The Dow, though, was dragged down over debt ceiling negotiations. So let's recap some of the biggest stock winners and losers of the month with Yahoo Finance's markets reporter, Josh Schaefer. Josh, what do we got?
Yeah, guys, so when thinking about kind of winners and losers, I was thinking about some of the themes we've been talking about over May, right? And so when we're going to talk about these winners first, we're going to go AI, right? So you have Nvidia, Tesla, which some are saying is an AI play to some extent, at least our friend Kathy Wood is. And then you have Urban Outfitters, which is sort of the consumer side of what May earnings was. And I want to talk about Nvidia first, because Nvidia obviously surprising the street last week with their earnings release, essentially coming out and saying that they expect to make more money off AI than anyone had initially anticipated, at least significantly more than Wall Street analysts had anticipated, right? You can see that stock now for the last month up over 40%, really driving that rally that we've seen specifically in the Nasdaq and in AI plays over the last month. Then you take a look at Tesla and what Tesla's done over the last month. Tesla up about over 20% in the month of May. Also on some AI hopes, I do think, and to some extent, right, in that tech rally, but also positive news for Tesla, new partnership with Ford. Ford will be using their superchargers. Also positive news out of China, sparking Tesla's run. I think also just interesting to see the open optimism that now is in that tech sector and in a play like Tesla that maybe wasn't there a couple months ago, especially with a potential Fed rate hike coming in June. Tesla was not the kind of stock that people were maybe buying when talking about Fed rate hikes going back a few months ago. Then you take a look at Urban Outfitters. Urban sort of shows the story up about 16% for the month. And this is the story of the resilient consumer that we saw in the month of May. We were all waiting for a consumer slowdown during this earnings season. It never really came, at least not fully. There were some warnings about discretionary spending, but investors have still found some winners in that retail category, and Urban seems to be one of them where people are still choosing to spend their money there. Now, when you take a look at losers, there have been losers in the AI space too. That's why we highlight Chegg here. There's also just regular earnings losers that disappointed Wall Street like Paramount. And then there's Peloton, which hit an all-time low in May. Starting with Paramount down almost 30% in the month. And really what that was driven by was an earnings disappointment. They're still continuing to lose more money than investors had hoped with that streaming platform. New research out in the last couple of days from Wall Street analysts pointing to overall Paramount just might not have as big of a total market in that streaming space as some had hoped. So it'll be interesting to see how that plays out when we continue to talk about the streaming wars. Take a look at Chegg. Chegg down over 40%, nearly 50% in the last month. You remember Chegg's earnings call was pretty much all about AI and how AI is taking some of their customers. So they plan to partner with ChatGPT, but really investors weren't that excited about that because now you're relying on someone else's technology to sort of build out your growth story, not normally a positive on Wall Street. The final one I wanted to highlight here is Peloton because I do think it's interesting. We've seen this resurgence in the Nasdaq, resurgence in some tech kind of stocks that were popular over COVID, but still fundamentals are driving things here for a stock like Peloton. Peloton projecting that they're going to see subscribers decline for the first time on a quarterly basis in the next quarter, or could see that happen. Also, they had that malfunction with the bike, and as I said, the malfunction with the bike and the seat forced Peloton to hit its all-time low. The stock off slightly today, but it's been a rough ride downhill, I guess you could say, for Peloton.
Oh, you could say
Josh.
that, Mr.
Always use that
Punster.
one. Always use that
Thanks,
one.
I was taking notes during your hit, Josh. If there's anything I took away, it's people clipping out of Peloton. People also have a lot of this AI fervor right now, a little bit of froth. And then lastly, people still buying holy shirts over at Urban Outfitters as well here for the summer.
They sell holy, is that a thing?
Oh yeah, lots of holes in the shirts, yeah.
Huh.
Urban Outfitters shirt on a Peloton using AI.
It breathes well.
The month of May in a moment.
Love it. Josh, thank you so much for breaking that all down here over the course of not just the earnings season, but the month of May, for sure. Also, we got to talk about the FDIC. The FDIC just released its quarterly bank profile. Our very own David Hollerith is live at the press conference. Dave, you've been listening in to what they've had to say about this report. What did you take away?
Yeah, Brad. So, it's one big bad number that we're focusing on. And some of the good news, I guess, is that this is something that we've known for a while. Obviously, the first quarter was many weeks ago. So U.S. banks lost $472 billion in Q1. And when I say U.S. banks, I mean FDIC insured institutions. So that also includes saving and loans associations, as well as commercial banks. The point that this comprehensive report gives us basically is it shows us sort of what has happened outside of that big number we were kind of already aware of. One example of that is that it looks like bank deposit data has mostly, a lot of the deposit outflows has mostly been uninsured deposits. Insured deposits actually rose during the quarter. Other things we're seeing is that the unrealized losses, which were sort of another part of what caused the banking turmoil that began in March, also appeared to have been reduced over the quarter. The list of problem bank, or the problem bank list, which the FDIC publishes every quarter too, which is kind of a confidential list they use to show which institutions are sort of getting to the brink of insolvency. It rose by 4 banks. So from 39 to 43, and that's actually still very low by historical standards. And the amount of assets on that list is only about $15 billion in assets, which obviously sounds large, but what it means is that there's no top 30 bank in the US that is on this list. And so that was one of the big things we're looking at. So obviously this is older data that's been aggregated at a sector-wide level. So it looks bad, and we've known most of the bad stuff, but now we're starting to see a little bit more from the FDIC in terms of what actually happened. It's the most comprehensive thing we've seen. And that being said, the FDIC's chairman, Martin Gruenberg, actually, he stressed that obviously this was only a few weeks of the banking turmoil as it kicked off in March, and the first quarter ended March 31st. So he said that second quarter bank earnings is going to also play a big role in terms of feeling out where the crisis is. That being said, it does seem as though, judging from the report, that things do seem a lot more stable. Ongoing concerns for the rest of the year, of course, is going to be the decreasing profits that banks are going to show, and that's all we're looking at from the report now. But there's tons of data.
And David, it's striking to me because we have been seeing stocks take a leg lower here for the past almost hour now, but it's financials that are leading. And even though this is backward-looking data, to your point, with this, look at unrealized losses, with the uptick in the troubled banks, it seems like that the people are maybe concerned about some of the implications of this report.
Yeah, I think that that's probably true. The big thing that I think this shows is that it's along with regional bank earnings when we first saw them, just from individual banks, it's that things are not as bad as were initially feared. So that is a good sign. But again, as I pointed out, there's all this indication and guidance from the FDIC's chair that it's going to be tougher going for the rest of the year for financials.
David Hollerith following all things around the FDIC and what they are tracking, especially around the banking turmoil that ensued mid-March. David, thanks so much for breaking that down for us. And coming up, everyone, a big deal, a story that's right up our alley. We'll tell you who's bowling a strike next. do a quick check of the markets sponsored by Flex Shares, taking a look at the U.S. major averages on a day where we got some U.S. economic JOLTS data. We're taking a look at the Dow, the S&P 500, and the Nasdaq, all in negative territory right now. The Dow down by about 0.9%, S&P 500 0.8% in the red. The Nasdaq Composite down a little more than 0.5%. And a big deal in the bowling space. Bolero has announced that it will acquire Lucky Strike in an all-cash transaction valued at roughly $90 million there. And this is a company that's been on a bit of a buying spree as I'm looking through some of the other deals that they've made, really regionally based. They went after a deal that was in Washington State. That one was for one of the regional players there, Paradise Lanes Entertainment Center. They also went after one of their first deals in the state of Tennessee as well. And this coming after some of the record-breaking results that they had to report for the most recent quarter as well.
Bowling alleys are largely still sort of a regional mom and pop kind of business. So Bolero has been the main player that's been rolling them up here. 14 locations is what it gets. I didn't even mean to do that. It gets 14 locations in this Lucky Strike transaction. Lucky Strike is a privately held company, and it looks like the total now for Bolero is 325 bowling centers. Remember, it also owns the Professional Bowlers Association. To be clear, Bolero shares aren't moving that much. We just wanted to talk about bowling because we like bowling.
We do.
Is that true? I think that's.
I enjoy bowling.
I think we're on the same end. That we were just excited about this deal. We know Lucky Strike. We know Bolero. Although I have to say I have not been in a Bolero in quite some time, in part because the prices are.
They're pretty up there.
Quite lofty.
I think
if you want to book your lanes in advance.
Right. I think I've only been for company events before, not on my own personal dime.
Exactly.
So typically with the group, and you've got a new CFO over at Bolero, so they've got an aggressive strategy, spending, hitting them with the "Who do you think you are?" I am. Pete Weber. Shout out there to PBA.
Bowling great.
Bowling great. Icon.
Exactly. I only know that because of what you put in our Slack this morning. On the agenda today, the debt limit deal struck by President Biden and House Speaker Kevin McCarthy is poised for a vote in the House. How could the agreed cuts affect transport across the nation? We're going to ask the man in charge of that sector on the federal level. That is Secretary Pete Buttigieg of the Department of Transportation. That interview's up next with Yahoo Finance's Rochelle Akufo and Brian Sazi.
That's it for us today, though.
It is. Stay with us for that interview.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufa. Here's a look at what I'm watching this morning. Heading to the House, the debt limit deal struck by President Biden and House Speaker Kevin McCarthy is poised for a vote today. But how could the cuts impact transport across the nation? We'll ask the man in charge of the sector, Secretary Pete Buttigieg. And a big month for stocks closes out with AI-focused companies in the driver's seat. The Nasdaq's rally was the story of May, but can big tech's strong momentum last? Citigroup isn't so sure. We'll take a closer look at market dynamics as we enter a new month. And supercharging the EV race, the Biden administration has set aside billions to boost the nation's charging network. But where is the US in its electrification goals? Our panel breaks down the issues facing the domestic EV movement. But first, let's check in and see how the major indices are faring an hour and a half into the trading day. We're seeing the Dow here still hovering around the lows of the morning so far, of about 270 points or 0.8%. The S&P 500, they're also down 0.8%, and the tech-heavy Nasdaq there still in selling action, but at least faring a little bit better than the other two, down about 88 points as we await some details on that debt ceiling deal. Let's also take a look at the treasuries as well. Short term, the 5-year up almost 1.5% there. The 10-year also up over 1% there, and the 30-year up about 0.6%. We're seeing the fear index, the VIX, ticking up above 18. So those jitters making their way through and that flight to safety. Right, well, let's start with our call of the day. Tech stocks are enjoying an impressive run so far this year. The Nasdaq Composite is up just about 25% year to date. And while investors are bullish on the tech sector right now, Citigroup strategist Chris Montague says it's the rally has a risk of losing steam. And here to break down the massive moves we've seen in tech is Yahoo Finance's own Shauna Smith. Hey, Shauna.
Hey there, Rochelle. Let's take a look at the massive gains that we've seen since the start of this year. Now, this probably isn't a surprise to many, given the fact that the AI frenzy has really been driving the investor narrative, at least as of late. But the Nasdaq 100, we're looking at gains of just over 30% since the start of the year. So this massive rally that we have seen play out in the sector is causing some on the street to warn that, hey, maybe some of this frenzy, we need to take a break. It doesn't have enough to maintain this type of momentum. At least that is what we're hearing from Citi's Chris Montague. Like you just said, he was out saying that this massive rally that we've seen, we might see it start to fizzle out just a little bit. He was pointed to two things that we're seeing. One, long positions in the Nasdaq 100. Right now, they're at a 3-year high. And also when you just take a look at these profit levels, they are very elevated right now. So investors are at risk if we do start to see some profit taking from these levels. Taking a look at exactly what we have seen play out in just the month of May alone. We have this chart here from Bloomberg, and we highlight just the massive jump that we have seen in May, up just about 8%. That is the best month of May that we have seen in 18 years. So really just highlights some of that frenzy that we have seen playing out right now. When we take into account what is actually driving it, two things. One, that AI frenzy, but also this bet from traders that we will see the Fed pause its rate hiking cycle, some things that they have been waiting on now for quite some time. When you take a look inside the sectors here, the XLK, the tech sector ETF, that's up 32% so far this year. Taking a look at that year-to-date chart, and it really has certainly been the steady climb up. Now, we know the tech sector was under a tremendous amount of pressure in 2022. So the thought here is when we talk about all this hype surrounding AI, maybe this is starting to turn into this FOMO type of trade, this fear of missing out. And of course, that is raising some alarm bells here on the street just in terms of what exactly that could mean. When we talk about the AI frenzy, take a look at how often AI was mentioned in earnings call this past quarter. So it was mentioned just over 110 times. That's up 40% on a quarter-over-quarter basis. So it almost seems like companies that aren't even have exposure to AI just yet, they're mentioning it, saying that they want to get into the space given the appetite that we're seeing from investors as of late. And taking a look at some of the outperformance that we've seen in individual names within the tech sector, certainly a lot of those larger cap tech giants have really been setting the pace here. Year-to-date gains, look at that. And Apple up nearly 40%. Amazon up over 40% here. Meta, one of the names that has been playing up the position that they have in AI. Those year-to-date gains up just around 120%. But we got to look at Nvidia. That's certainly been one of the outperformers, massive outperformers since January 1st, up nearly 170%. We've seen a number of the chip stocks also riding that wave, riding that excitement into AI. So we'll see whether or not that holds. But again, the fact that we have seen such a massive run up since the start of the year, that's causing some analysts on the street to warn that, hey, maybe now's not the best time to jump in, maybe wait for that pullback and then start to re-enter some of these very, very popular names. And that is certainly what we're hearing from Citi's Chris Montague today.
Well, certainly as we look at Nvidia, they're off to the races, though, indeed. A big thank you there for that update, Shauna Smith there for us. Well, something else on traders' minds, the debt ceiling deal is set to face its final hurdle. Congress will vote later this evening on President Biden and House Speaker Kevin McCarthy's bipartisan agreement to raise the debt ceiling and limit government spending before the so-called X date. We're joined by U.S. Secretary of Transportation Pete Buttigieg alongside Yahoo Finance's executive editor Brian Sozzi. Great to have you both with us. So first, Secretary Buttigieg, I want to ask you, we know that some of the cuts to transportation, that funding was on the table at one point from McCarthy there. What do we know now about how some of these cuts and these negotiations will impact your department?
Well, the effect will be much more attenuated compared to what we were facing when that bill passed through the House. The unilateral House Republican bill would have meant really savage cuts to a lot of very important things that we do, from rail safety to air traffic control. We're still assessing the best ways to accommodate the caps and the restraints that are part of this deal. Not everything that we would want to see, but that's what you're going to get in divided government when there's a negotiation. I don't think either side got everything that they wanted, but at the end of the day, this is a deal that is workable, that is consistent with our department's ability to meet its mission, and most importantly, that will prevent a default that would just be absolutely unacceptable and economically catastrophic, which I think is what everybody's rightly focused on, making sure that America can put behind us so we can get on to work after that X date with a deal in hand.
Mr. Secretary, just staying on the debt ceiling deal, does that impact any cuts there? Does that impact efforts that you've undertaken to improve rail safety and to improve travel by airlines in this country?
We're certainly going to be able to continue our work, and I would add that there's more to come on this, not just what's happening in terms of the budget, but active legislative processes on both. When it comes to railway safety, there is the Bipartisan Railway Safety Act, which was advanced through committee. Would like to see that pass the Senate and the House and get to the president's desk, because it gives us more tools to work with to hold these railroad companies accountable. I think before the Norfolk Southern derailment, many Americans hadn't seen just how often incidents happen around the country. This is going to be a major step forward in preventing more of those. On the aviation safety side and the customer service side, we are full steam ahead. We are advancing a rule that would create compensation for passengers when an airlines are responsible for a major delay or cancellation. We're working on rules around fees and refundability, transparency. All of that work is going to continue in the context of this bipartisan deal.
Mr. Secretary, you mentioned Norfolk Southern, the railroads. Now, I talked to Norfolk Southern's CEO about a week and a half ago and try to get a sense on where he is at after the derailment. Now, he told me they are not going to stop fully implementing precision railroading, which a lot of experts suggest are leading to derailments for Norfolk Southern and a lot of others in the railroad industry. What would be your response to that? Is that something that must end?
Oh, I expect every railroad company to go, not just to meet the letter of the law, but to go the extra mile when it comes to safety, and we're pushing them to do that. I continue to be concerned about this push for cost cutting. A lot of these measures go by the collective name of precision scheduled railroading, although I've never seen a completely satisfactory definition of all the things that go into that. Bottom line is there needs to be a level of safety and accountability. I'll give you an example that we're continuing to pursue, which is a requirement that there be at least 2 people on board a train. To me, this is basic common sense, but believe it or not, railroads have continued to push to be able to have just 1 person, even on a train that could be 2, 3, or more miles long. I also want to mention, by the way, that we're doing work that doesn't just depend on what railroad companies do or don't do to improve infrastructure in ways that is going to mean fewer railroad crossings, locations where there's more of a hazard of a crash, and just as importantly, even if there's no incident or collision, you have long trains or stopped trains getting in the way of people and sometimes emergency vehicles going about their days. One of the great things about the infrastructure law is it provides us funding to act on that, and we're working with communities, and we'll be making announcements soon about that railroad crossing elimination. So we're making sure that it is safer and more convenient. We're pushing the railroad companies to do the right thing. And let me mention one other thing that I was pleased to see Norfolk Southern announce, and several of the Class 1 railroads have taken steps toward, which is reaching agreements with their unions to deliver sick leave. You remember this was a big sticking point and a very tough issue last year as we faced a possible strike. The strike was prevented, but the president and the administration continue to say we believe that all railroad workers ought to have sick leave. With these deals, these now bring us into the reality of a majority of union railroad workers in America having access to that sick leave. And of course, we'd like to see that majority become 100%.
And Mr. Secretary, I want to shift gears here, still staying with infrastructure, but more so looking at the EV space, looking at this deal between Ford with its Tesla supercharger network here. This also will give some of these Ford EV drivers an adapter. But I mean, what does that mean for the current industry standard, for the current charging network that we have, and the upgrades that might be needed then for some non-Teslas or non-Ford cars?
Well, bottom line is we're really glad to see this deal and any deal that means more access for more drivers to more electric chargers. I mean, here we are on an aggressive journey to get to the president's vision of 500,000 chargers by the end of the decade across America. And there's already this remarkable charging network that Tesla has built. So for that to be accessible to more drivers is, I think, very positive news. Now, a lot of comparisons have been made. I've made these comparisons myself to where things were back in the early days of VCRs and that VHS versus beta moment that you really want to get out of as quickly as you can. But one thing that's important and different here is that adapters can come into play on the connector. I don't want to dismiss how important the connector is, but it is in many ways, because of that adapter, one of the less difficult parts of getting a charger installed compared to the utility work, the site work, putting it in place, making sure it's got the power, the reliability, the payment systems, and all the rest of it. We continue to be in this moment where there are competing standards, and we're not going to put a thumb on the scale and dictate one standard or another. What we are doing is we're setting basic standards for any charger that's going to be part of the programs we're supporting as an administration, that it be interoperable, that it be transparent about pricing, that it be accessible, because we really do need to get to a point where it is no more difficult, complicated, or unpredictable to charge your car than it is right now to fill up a car with a tank of gas.
Because, Mr. Secretary, that is one of people's main concerns when considering an EV. Will I be able to access charging stations? How long is it going to take? For people who, perhaps want a cleaner, greener option, but they're not really seeing that infrastructure in place, what sort of funding is going into that accessibility, and how soon will we see it as widespread as some of the interest that we're seeing in the EVs themselves?
Well, we're making major investments on this. As a matter of fact, $7.5 billion in the infrastructure law that we're now getting out to states and to communities. We have a community charging infrastructure program for largely for places where you have, for example, a multifamily dwelling where it just isn't yet profitable for a for-profit company to do it. But also the overall nationwide system, the national network that we're building, partnering with the states. So again, instead of dictating everything from here in Washington, what we're doing is we've invited each state to submit its plan. They get a set amount of funding by formula to work that plan and get the chargers up. And you're going to see the construction, even this construction season, I think is going to lead to more and more access. And again, we've got a very aggressive goal of 500,000 chargers by the end of the decade. The other thing I want to keep reminding drivers of is that many American drivers, as a matter of fact, a majority, have access to some kind of charging infrastructure in the form of a plug in the wall. There are many ways in which charging an EV has more in common with charging your phone than filling up a car that runs on gas. It's just a different paradigm than what we're used to with how we've been filling up internal combustion engine cars for decades now.
And Mr. Secretary, we're smack in the middle, or we're getting ready to get into the peak summer travel season. Now, I believe it was your agency that put forward penalizing airlines if they can't deliver on time. Where does that stand? And then how concerned are you that airlines may come out and raise prices for summer travelers in advance of something moving in that direction?
Well, it won't be ready this summer. It takes a while to get a regulation like that done, including a period where we're going to take input from passengers, from industry, and from everybody else. But we are moving forward with this process because we think it's important that you have access to compensation when you've lost hours or even days because of something that an airline could have prevented. And what we've seen in places that have done this, there's been something comparable to this in Europe for many years, in Canada, is that it is definitely consistent with affordable airfares. It doesn't have some unreasonable effect. Now, I also want to say this. What we saw over this last Memorial Day travel weekend was dramatically improved results compared to a year ago. Remember last summer, even on so-called blue sky days when the weather was fine, we still saw airlines running into massive problems, cancellations, delays, not being ready, schedules that may not have been realistic, staffing that wasn't where it needed to be. We pushed hard on the airlines and took steps that were under our own control with the FAA to improve operations. And the first big test of those improvements came this last weekend. We saw the most passengers in our airports that we've seen at any time since before the pandemic. And the system performed quite well. We saw less than 1% cancellations on each of the days over that busy Memorial Day travel weekend. And so far this year, we've been seeing cancellation under 2%, actually every month, which is not something we've seen in about a decade. So I want to give the airlines some credit here. You know, we have collaborated and we have gotten a lot done that has helped to make sure there's a better passenger experience. But we're not out of the woods. And when you have a bad experience as a passenger, we're going to be there to protect your rights and to make sure that the airlines do right by you. This rulemaking is one part of that process.
And Mr. Secretary, for people who are taking road trips or perhaps need better travel options, not just for leisure, but also for commuting as well, talk about the Reconnecting Communities program and what that actually does for communities themselves and what the hope is for the funding there.
Well, the great thing about reconnecting communities is that it recognizes that the purpose of transportation infrastructure is to connect and not divide. In the past, that hasn't always happened. You've had freeways or railways that cut right through communities, often lower income communities and communities of color, and to this day can be a barrier between people and jobs or just the ability to get around your neighborhood or your city. What we've been able to do with this funding is to improve that. We had a big announcement in Buffalo where we're going to put a cap over the Kensington Expressway, allowing cars to continue to move, but restoring a neighborhood that was torn up when that highway was originally built. In other places, it's a lighter touch, maybe an overpass or an underpass, helping pedestrians or vehicles get over or under a railroad or a highway. There's an interchange in Tampa that really caused a lot of problems for a community that we're now able to redesign and fund that community in improving. What I love about this is it doesn't make anyone worse off, and it makes a whole lot of people better off. And it shows that here in the 2020s, we're going to make decisions a little differently and a lot better than we did as a country sometimes 50, 60, 70 years ago. Decisions that people are still living with that we can improve on. And that's exactly what we're doing with those dollars.
I do appreciate you joining us, Mr. Secretary. Thank you for your time today. Pete Buttigieg is, of course, Transportation Secretary of the United States. We appreciate your time this morning, and our very own Brian Sozzi as well. Thank you so much.
My pleasure. Thank you.
All right, coming up, congratulations to the class of 2023 and welcome to the real world. Before that first paycheck hits, we've got financial tips for recent grads coming up next. Let's do a quick check of the markets sponsored by Flex Shares. Still looking at some selling action here, though, off the lows of the day so far. The Dow now off more than about 250 points there, 0.7%. The S&P 500, they're also down about 0.8% there. We're seeing consumer discretionary weighing the heaviest there. And then on the Nasdaq, we're seeing that down by 111 points or 0.8%, seeing some of that selling action picking up as well. Well, it's graduation season, and the young people entering the workforce now are coming into an uncertain macroeconomic environment. But how can they best set themselves up for financial success? Our next guest has some tips for you. We have Teresa Arrigo, Gen Wealth Financial Advisor. Thank you for joining us this morning, Teresa. So, as we're seeing a lot of these new grads perhaps getting ready to get their first paycheck, when you think of budgeting and saving, you immediately think restrictive, your eyes glaze over, you're like, no, I just want to spend my money and have fun. What are the biggest selling points in really getting your budget and your savings plan sort of fortified right out of the gate?
Yes, thank you so much, Rochelle, for having me. I love that you guys are taking some time to focus on this because there's such a great opportunity when you've completed your degree or your training program to set some good boundaries in place. So I think of a budget as kind of like a fence. If you are building your house, you're likely to put up a fence to create some boundaries. That's the beauty of a budget, is it creates some boundaries to align your spending habits with your values. And if you do that properly, then that opens up a lot of other opportunities for you through savings, whether that's having emergency savings to avoid debt and build really healthy habits, or if that's getting started on investing. And what I love to kind of think of when we talk about investing is small steps really do add up. So those day-to-day decisions in your budgeting help you create margin for saving. And imagine this, if you started at age 22 saving for retirement in a Roth IRA and you put $100 a month, so we're not going crazy with numbers here, but if you were able to do that until age 65 and earn 7% average return, which is not anything fancy, you would have over $350,000 saved up already just through that one small move. And if you got 8% return instead, then you're up to $489,000. So even just a small step like that over the long haul can really add up over the long term. And by the way, you would have only invested a little over $51,000 to get there. So that's a huge benefit of that. And then the next thing that I would encourage you to consider, go ahead.
Well, I was going to ask, since you brought up Roth IRAs, so you have like traditional IRAs, Roth IRAs, your potential employer offering you a 401k. How do you weigh out the best option for you?
So that's a great question. When we're talking to our clients about kind of the priorities of investing, first, you've got to have savings, because you don't want to have to dip back into your investments. Second thing you want to do is really maximize your employer plan. Some employer plans do have a Roth option in them. Some just have pre-tax, which is okay too. But you want to make sure you're getting the full match before you do anything else. And then if you have the option of doing a Roth, because there are some income requirements to that. So if you have the option of doing a Roth versus a traditional, the biggest difference is that at retirement, all that money is tax-free. Of course, you're giving up the tax benefits on the front end when you do the Roth, but usually when you're first starting out in your career, you're getting a refund anyway. So there's not a huge benefit of using the pre-tax if you don't have to.
And so what are some of the common traps that can derail your savings and investment goals, especially when you're just sort of starting out and trying to figure out how you should prioritize your money?
So one of the biggest ones that we see is overspending. I think in general, Americans have this habit of living right up to their means or just past it, which is why we have so much debt here in the United States. So the first thing is not having emergency savings or not having good spending habits in general. Another one we see is what we call lifestyle inflation. So as you get new jobs, you increase your expenses in kind of in alignment with that. And then another huge opportunity missed is if you have moved from one employer to another and you liquidate that old employer plan and you use it, you're going to pay some penalties on that. The general penalty, if you're under age 59 and a half, is 10% of the withdrawal. And then it's also taxable as income to you. A lot of people don't realize you can take that employer plan and move it to the new employer if they'll accept rollovers, or you can transition it to a traditional IRA or a Roth IRA, depending on how it was sitting in the old employer, and keep it invested for your goals.
Yeah, you certainly don't want to leave money sitting on the table, especially with those taxes coming in as well. A big thank you there to Teresa Arrigo, Gen Wealth financial advisor. Thank you for your time today. All right, coming up, we've got more market coverage, and we'll be taking a deep dive into electric vehicles and the infrastructure the US needs to support them. That's next. Now let's go to Yahoo Finance's Jared Blickery for a check on the markets. Hey, Jared.
Hey there. As we can see, red arrows across the board. In fact, all over across the world. Don't see that every day. Dow down about 0.8%, S&P 500 and the Nasdaq just a tad more. The small caps down about 1.7%. So it has been rough for the small caps recently, as well as the Dow. And then, as we know, we've been talking about the AI trade, really the one gleaming spot of hope in the market right now. Here's what's happening in sector action. The only thing green is defensive. So take that with a grain of salt. We got staples, utility, real estate, all just slightly positive here. Consumer discretionary, that's XLY, that is taking it on the chin. That's down 2%, followed by financials, industrials, and energy. Also materials in there. All of those underperforming, so it looks like a pretty strong value or lack of value in the market right now, at least as I would say they were thinking of the market that way. Anyway, let's go to our leaders in sentiment. We have Bito, that's a Bitcoin ETF, that's down about 3.8%. Kind of shows you where the fringe money is or is not right now. KRE is a regional bank ETF, that's down 0.4%, so we're seeing kind of a resurgence there. And I'd also point out it is the end of the month, and that just means there can be some portfolio rebalancing anytime you have a huge move up, as we've had in certain stocks. Sometimes you see some of that given back at the very end, and it doesn't mean a whole lot. Could be the case, but just keep that in mind. Here's the S&P 500 over the last 3 years. Just want to remind everybody we are still in a giant trading range. Even the Nasdaq, which has broken more to the upside, still pretty much in a giant trading range, although this is positive price action right here. So take all of this with a grain of salt. We got the US dollar perking up, but as long as that stays under wraps, we got the potential here for continued momentum to the upside, but it's going to be dicey, as we know.
We'll be keeping an eye on that. Great stuff there. Thanks so much, Jared. Well, some called it a game changer or at least a big step forward. Last week, Tesla and Ford announced that Ford electric vehicles would be granted access to the approximately 12,000 Tesla supercharger stations in North America. Now, that surprise deal is expected to go ahead in the spring of next year and makes Ford the first automaker to become an explicit part of the EV leaders network. Now, the announcement comes as the US tries to scale up its electrification efforts. The Biden administration has earmarked billions in funding for the sector. So the EV market is changing rapidly. Well, what can we expect to see? And what will those changes do to the economy and the companies at the forefront? We're joined by Plug-in American Executive Director Joel Levin and GreenBiz Group Director of Transportation Vartan Badalian as well to discuss. Thank you both for joining us. Joel, I want to start with you here. In terms of this announcement, what struck you about the fact that you have this legacy car maker now teaming up with Tesla here on the superchargers?
Yeah, it's a really big deal. We were really excited to see it. I mean, one of the big challenges that people have is that the public charging network is not as reliable as it could be in the US. A lot of people complain about broken chargers or chargers being busy or hard to find them. And the Tesla network really gets high marks. The users really love it. That's what we've seen. And so in Europe, Tesla has opened up their network to other car makes, but not in the US. So for them to do that with Ford here is a really big deal. Tesla has a really significant advantage in terms of people who like to travel long distances and go on road trips because their network is so widely regarded. And so now Ford, by gaining access to that, that's really a positive thing for people that are looking for cars to go on a road trip. I think it's really a big plus for Ford.
And Vartan, I mean, if you're a non-Tesla or a non-Ford owner and you're looking at this and looking at some of perhaps your public charging options and the reliability issues there, what should you think about this?
Yeah, it's a very valid question. I think there's two groups of kind of changes that are going to start happening. You have the OEMs that are quickly, I think, going to start catching on to what Ford did because the CCS market, as Joel mentioned, is struggling with reliability concerns. So I would be wanting to suspect that in the coming years, we will see more OEMs kind of catch on and deploy what Tesla's port connector is for their vehicles as well, largely given the reliability benefits of their network. On the other hand, if you're a consumer kind of purchasing vehicles and looking at the market of EVs that exist, there are a lot of great EVs that are on the market right now. But then the number one reason why I think consumers now pick Tesla over other car makes is because of the supercharger network. So it's something that the industry has finally caught on to, and we will see some transformational change come about from it.
And Joel, what sort of changes are you expecting here? I mean, when you have Tesla, we saw the recent report there showing that it's, in terms of global sales, the Model Y at the top of the list, they're beating out Toyota in terms there. So then, but when you look at the infrastructure and you want that to catch up, I mean, keeping in mind a lot of those numbers were China focused, but where does that leave the US in terms of the companies that are at the forefront of really stepping up the electric charger stations?
Right. Well, I mean, I would put it in perspective. Keep in mind that charging an EV is not the same as buying gasoline. So the majority of people get most of their fuel at home. So people generally charge at home or at work. The vast majority of all charging, people do overnight while they're sleeping. And so with an EV, you wake up every morning generally, and it's like having a full tank of gas. So the charging network, it's not quite as critical as the network of gas stations. In that you don't, you're not using it every day. For most people, you're using it on road trips. And then, of course, Tesla is still half the market in the US. So for the Tesla drivers, this doesn't change anything. And so it's not that dramatic of a hindrance. And I think that the public EV networks are focused on trying to solve this problem. the federal NEVI program that's going to create a national charging network across the country along large highways is very focused on trying to improve the driver experience, improve reliability, and improve the way that people pay. And so I think this is a problem that's going to kind of go away over time as the federal charging network rolls out, because they've created very high standards for it.
And Vartan, what do you think is going to be the next inflection point, the next catalyst that really gets more EV adoption up to speed here?
I mean, largely the point we've been talking about, I think it is going to be a unanimous consensus that EV charging is more reliable than it currently is right now. I mean, Joel's points are very accurate. A lot of the charging experience happens at home or at work and is not typically on the fast charger in the public setting. But when you have more and more stories coming out increasingly in the American culture of going on road trips, people want that convenience of a fast charge quickly and, of course, reliably, given they've purchased a $20,000, $30,000, $40,000 vehicle. So I think once we start seeing more reliable chargers, both in the public network that kind of grows as the federal push kind of pushes that forward, we will start seeing this next wave of adopters. Because right now, up until this point, we've had we're approaching actually around 10% EV adoption for new car sales in the U.S., much more in California, and somewhat similar around Europe and elsewhere. And that's largely been early adopters. But now we're moving into the non-early adopter phase. And I think the charger reliability story is going to be where we transition to a greater bulk of consumers.
And Joel, so then in terms of dealerships, the availability of some of these EVs, how affordable they are, and even whether they're good value at the moment when you try and look at the pricing, what are your options for that, for people who are perhaps saying, you know, is it worth the investment up front, being that it is higher in a lot of cases than your traditional, you know, petrol-powered car?
Right. Weirdly enough, it's not. It seems like it is. What's really important, so a couple of questions, let me unpack that. First of all, in terms of supply, about 6 months ago, towards the end of last year, there was really kind of very limited supply of EVs available in dealerships. It's gotten significantly better since then. So it's easier to find available cars right now. In terms of the value, what I'd say is what's important is to look at not the upfront cost of the car, but look at the total cost of ownership. Because with EVs, the price of fueling is so dramatically cheaper, particularly if you're buying your electricity at home. It's typically somewhere in the range of probably $1 to $2 a gallon gasoline equivalent, but it's a lot cheaper than gasoline. And then maintenance is also much lower. Consumer Reports did a study and they showed that over the lifetime of the car, maintenance is about half the price of a gasoline car, because there's no oil, there's no spark plugs, there's very few belts and things to change. So EVs just have much lower maintenance. So when you're looking at the price of an EV, don't just look at the upfront price. Look at the monthly cost of owning it compared to a gas car. And if you're looking apples to apples at equivalent EV to a gas car, don't compare a Tesla to an inexpensive gas car. Compare two similar cars, and you'll see that EVs are not actually more expensive overall in terms of the cost of ownership. So they're a great deal. Used EVs in particular, I think are a really attractive deal. People tend to shy away from them because there's a fear that they're going to have problems with the batteries. But in fact, the batteries are pretty reliable. We get this question all the time. What's it going to cost me when I have to change the battery in my EV? Well, people don't. I mean, unless there's a defect in your battery, in which case it's probably covered by the warranty, people very rarely change the battery. It'll probably last as long as the rest of the car. It's like, how often do you change the engine in your car? Well, not very much.
Certainly important context there when you're looking at that initial price tag versus sort of the length over the course of the car. A great discussion. Thank you both for joining us this morning. Joel Levin there, Plug-in America Executive Director, and Vartan Badalian, Green Biz Group Director at Transportation. Thank you so much.
Thanks.
All right, coming up, shares of HPE are falling today, but its CFO is touting its investment in AI. We'll share our interview next. Shares of HPE are in the red today after the company took a hit from a slowdown in spending on cloud services, bringing second quarter revenue in below expectations. Despite weaker than expected revenue forecasts, the company sees potential with artificial intelligence. Tarek Robiati, Hewlett-Packard Enterprise CFO, joined Julie Hyman, Brad Smith, and our Brian Sozzi to discuss earlier today.
The AI opportunity for HPE is very, very significant. And it comes from the fact that we have unique manufacturing and engineering capabilities to assemble the large systems that are needed to test AI models. And by way of an example, as you may remember, in the first quarter, we delivered the largest supercomputer on the planet, which was Frontier, which is a system that powers simultaneously 37,000 GPUs that work as one machine to test complex models for the Department of Energy over here in the United States. And so on the back of that, we are winning substantial orders from our customers. So far, in the past few months, we've earned $800 million worth of orders and counting, and this number is set to grow more and more. Why is that? It's because to test those AI models of the future, you need a very substantial computational power, which we're capable of building. And then in answer to the second part of your portfolio, the portion of the portfolio that is currently experiencing a slowdown is a traditional compute servers business that we have. It is representing less than 40% of the total revenue of the company. The rest, our AI business, our intelligence edge business, are performing extremely well, and our Aruba networking business has grown 50% year over year and 15% sequentially, which shows there is still a lot of demand at the edge, which we intend to capitalize on. And so when you look under the hood at our results and our earnings, you see a tale of two stories. The traditional server business that is slowing down and it's cyclical by nature, but you're seeing a lot of growth in AI and at the intelligent edge.
Tarek, Brian here. Good to see you as always. $800 million of AI-related business. That's a huge number, and I think that surprised a lot of people out there. When you talk to investors, do you think they're underestimating HPE's opportunity in terms of sales and profits as it pertains to AI? Because I hear a number like that from HPE. I think what Nvidia said last week, I mean, that guidance from them was about a couple billion higher than consensus expectations, telling me the street is just way off in how they model companies like this.
That is true, and I think, you know, there is a lot of hype around AI, and there are lots of companies that claim to be AI-like. Then the question is, who are the companies that are capable of building those systems? And we feel we are one of them. We believe that we have the track record as demonstrated by Frontier to really deliver very large AI systems that are needed for the future. Because the reality is, when you're testing an AI model, your AI model is as good as the amount of data it has been tested with. And to test that amount of data, you really need a very large machine. And small AI systems are not going to be able to deliver on the promise of the future, which is very accurate models that are predictive of what's happening in a particular industry. So you have to look at this under a critical lens, because there's a lot of hype in that space, and be discerning, please, around the opportunities and the companies who can pursue this new wave of growth.
Right, and so because of that, yeah, we've probably heard a lot of talk, but kind of sparse on details over the course of this earnings season, especially with all of the AI mentions that we've gotten. You gave us a figure in that $800 million worth of orders, but if you think further out, are you able to quantify the benefit to the revenue run rate that you would expect to achieve because of the AI investments that you're making right now?
The 800 number is just a start, and we see the opportunity being much larger as there are different business models emerging for us, whereby we either build those machines for cloud providers, and some of the $800 million that were realized in terms of orders were around customers in the cloud space. There is also different types of business models where we are going to build machines ourselves for us to on lease with our GreenLake platform. There's many, many opportunities that we can capitalize for the future at HPE around AI with the technology and know-how that we have.
That was Tarek Robiati, HPE's CFO. All right, coming up, more on the markets and a new commercial real estate fund that could help borrowers strapped for cash. Stay with us. Fundrise CEO Ben Miller recently announced that the company will be launching a new credit fund, the Opportunistic Credit Fund. Miller says that Fundrise has been seeing too many deals and not enough dollars in the commercial real estate market. Yahoo Finance's Danny Romero has those details for us. Danny, what are you watching?
Fundrise is finding a bright spot. This fund is an opportunity for investors to profit off of the commercial real estate, given the downturn that is happening. The firm plans to focus lending on residential landlords. The process is still in the early stages, but they're hoping to roll it out in the next 24 months. And the current environment shows that banks are pulling back, and Fundrise is filling that gap with this fund. The firm is betting on residential landlords, given the fact that there is stable demand in apartments, also rental homes. And over the past few years, the firm has spent time accumulating apartments, also single family rental homes. And another side to this, specifically in the single family rental market, rents aren't slowing down, Rochelle, yet. Invitation Homes, a leasing company, said in their earnings call that new lease rents grew over 5%, and the company is still very bullish and has a favorable outlook ahead for this sector. So, very bullish for investors when you're looking ahead in this market, Rochelle.
All right, well, thank you. That's an interesting update there. Danny Romero there for us. On Tuesday, President Biden and House Speaker Kevin McCarthy reached an agreement on the debt ceiling. Today, that agreement is being voted on by the House. We're joined now by Twin Focus co-founder and managing partner Paul Karger, who believes that this latest debt ceiling agreement is just another way to delay the issue until the 2024 presidential election. Thank you for joining me this morning. So break down that base case. I mean, a lot of people didn't think that we'd end up sort of in this free-fall default situation, but you seem to think this is more about political posturing than really making any serious decision on the debt ceiling.
Absolutely, Rochelle. Great to be with you again. As you noted, Biden and Speaker McCarthy did come up with a plan, as we anticipated. We were calling for this a few weeks ago, and it seemed the market was too. The market really had the playbook on this debt ceiling. Listen, it was posturing on both sides. No side came out completely happy, kind of, in the words of, in the words of Larry David, kind of a great compromise where both sides are a little bit unhappy. But truly, all they do is kick the can down the road to, a few years out, just after the next presidential cycle. This really doesn't address the budget deficit. It's really just focused on the discretionary spending over the next few years.
And so why do you think we're still seeing the jitters in the market at the moment? I mean, no one really expected a default here, but we're still seeing, some selling action today.
Yeah, the market's down, less than 1% or so. I think a lot of it, really has to do with some of the slowdown that we're seeing. China's off a bit. China's not as strong as expected coming out of the COVID zero policies. And, Europe is still experiencing this industrial slump. So, again, the world continues to flirt with some kind of recession, whether or not we have a full-blown recession or some kind of mild recession or some kind of recession in certain sectors is still remain to be seen. But I think the market is concerned about the weakness in the economy.
And that did seem to offset some of the confidence that they at least saw from the FOMC meetings that did at least signal that at some point the Fed is going to be ready to sort of hit the pause button there. What is your view in terms of the outlook here for markets and what they're pricing in for what the Fed is going to do?
Well, as we all know, markets are really dependent on the direction of interest rates at this point. There seems to be some indication that the Fed has reached some kind of terminal value. I think it's north of 60%. The market's pricing in some type of rate hike, maybe 25 basis points at the next meeting, less so in the July FOMC meeting. As they've said, it continues to be data dependent and data driven. We do believe we're reaching some terminal value. We don't think we're going to see some rapid decline or cuts in rates anytime soon. The world still tends to grapple with this inflationary issue. You're seeing some disinflation, on the commodity front. As we know, commodities are off significantly, nat gas in Europe, for example. Which should give some reprieve to consumers and corporate. But remains to be seen, dependent on the direction of interest rates.
And do you think deflation concerns now then are perhaps outpacing what we're seeing in terms of inflation worries?
Certainly on the commodity side, we're not seeing any relief in wages. And, as your prior commentary reported, we're certainly not seeing much relief on rents, which are, both big determinants in the inflation number. So, it remains to be seen. Who knows? We could see wages pull back a bit if we do slip into a recession. At this point, we're predicting perhaps a light recession, or maybe we're able to escape the recession. There's a lot of liquidity out there able to address a lot of these concerns in the credit markets, but I do think we'll get through it.
And for clients who are looking at equity markets and looking for opportunities at the moment, especially seeing the tear that it's been on so far this year, how are you advising them?
On the equity markets, we tend to be more conservative. We continue to focus on utilities and consumer staples, goods that are, stocks that are more focused on cash flow. We do like credit markets, as has been, extremely discussed in the popular press. Credit is really appealing here. The banks have pulled back in lending, and there's a big gap. And, from corporate to real estate, we don't necessarily see a widespread fallout in commercial real estate, certainly some sectors, office in New York and San Francisco and so on. But we think there's a lot of opportunity for credit, as you've previewed on your show here.
Well, there you go. Some places to look indeed. A big thank you there to Paul Karger, Twin Focus co-founder and managing partner. Thank you for joining us this morning.
Thank you.
All right, well, let's do a final check of the markets before we go. Still seeing red across the board here, although some of that selling action slowing down. We're seeing the Dow off its lows here, but still off about 0.7%. They're about 240 points. The S&P 500, they're also down about 32 points or 0.7%. Also in similar territory, down 0.7%. The Nasdaq, as we're seeing, they're down about 94 points on the day as well. Still a lot of uncertainty about what the Fed may do next, as well as waiting for that debt ceiling deal to be finalized. That does it for now. I'm Rochelle Akufa, but I'll be back with you at 11 a.m. Eastern. I'll see you tomorrow.